Good morning. Welcome to today's conference, Promises Made, Promises Kept, Keeping Our Promises to Vermont State Employees, Teachers, and Taxpayers. I'm John Pelletier. I'm the director of the Center for Financial Literacy, and I'm very proud to be co-sponsoring this event with the Vermont Business Roundtable. We're so honored today to have such a distinguished group of attendees at this event, consisting of government, education, business, and nonprofit leaders from across the state. We're also pleased to welcome national experts that will share their wisdom with all of us later today. I want to make sure that everyone in the audience is aware that the Regional Education Television Network is filming today's conference, and the film will be made available through the Business Roundtable at some point, and also we would expect that this event will be broadcast on public access television throughout the state. Many state and local retirement healthcare plans are currently on an unsustainable path. The goal of today's conference is really quite simple. We want to make sure Vermont does not join the growing list of states that have severe benefit problems. Vermont has made retirement and healthcare promises to state workers and teachers. I believe all Vermonters want to keep these promises so long as they are treated fairly as taxpayers. Today we begin a discussion of how we can strengthen our public and healthcare plans so that Vermont can keep its bargain with these employees and also with the taxpayers. There are storm clouds on the horizon that threaten Vermont's public pension and healthcare plans. Perhaps the storm will pass Vermont by, or perhaps, like Tropical Storm Irene, it'll be a direct hit. The question really is Vermont prepared for these potential threats? I want to briefly review with you three risks that I'm personally concerned about that I believe Vermont faces: investment risk, longevity risk, and economic growth risk. The cost of all of these risks are exclusively borne by our taxpayers. Investment risk is the risk that the plan returns are below expectation. We are currently in the midst of the second longest bull market since the end of World War II. The bull market will be 9 years old next March. Are Vermont pension plans prepared for another bear market, which is definitionally a decline of greater than 20% in the equity market? Today, equity markets based on many different valuation metrics is viewed as being overvalued. Many market experts predict low equity returns of about 6% on most global equity investments for the next 5 or 10 years. Interest rates paid on bonds are a very important source of pension plan income. Interest rates are currently near historical lows and have been since the beginning of the Great Recession. At the turn of the century in the year 2000, which seems so long ago, 10-year Treasury bonds returned about 6.4% in interest each year. Today, these 10-year bonds pay 2.4% a year. Experts predict a slow but steady return to more normal interest rates in the future. This is bad news for bond investments held by a pension plan. As interest rates increase, the value of bonds decrease. If a bond portfolio had a 10-year average duration, it will decrease by 10% if interest rates increase by 1%. Many in the investment industry are warning investors to expect lower returns for much longer. Our state pension plans are based on an expected return currently of 7.5% a year. The question is that the right return for the future? CalPERS, one of the largest pension plans in the United States, reduced their return rate assumption to 7% in 2016. The second risk I want to talk to you about is longevity risk. Longevity risk is the risk that plan beneficiaries live an awful lot longer than we expect. If you were born on this day in 1947, you are 70 years old today. In 1947, the life expectancy of a newborn infant was 70 years. Today, the life expectancy of somebody born in 1947 is 85 years. Life expectancy has increased by 2 years each decade over the last 7 decades. In May, the World Economic Forum issued a report entitled, "We'll Live to Be 100. Can We Afford It?" The report notes that someone born in the United States in 2007 has a life expectancy of 103 years. Our public pension plans were not designed for 30 to 40 years of retirement. Without changes, in the future, you could literally have many individuals collecting retirement benefits for more years than they work. The third risk I want to briefly talk about is economic growth risk. That's the risk that Vermont's economy and our tax revenues do not grow as quickly as expected. The current economic recovery is the second longest since the end of World War II. At some point in the future, we know we're going to have another recession, and it will result in a drop in Vermont's tax revenue. Vermont's economic growth is equal to its labor force growth rate plus its productivity growth rate. Vermont's population and its labor force are shrinking. This puts severe limits on Vermont's economic growth potential. Vermont should expect subpar economic growth in the future compared to many other states. Vermont is the second oldest state in the nation. Only the state of Maine is older. In fact, 1 out of every 6 Vermonters is older than age 65. The number of working age Vermonters, ages 18 to 65, will continue to decrease as each and every day 10,000 baby boomers in the U.S. turn 65. That will keep happening until 2030. Unless things change, Vermont will have many fewer wage earners and taxpayers in the future. How will Vermont fund these benefits with a shrinking tax base and low economic and tax revenue growth? The speakers you will hear from today have strong and differing opinions. As Vermonters, I know we can have a frank, honest, and civil dialogue. We hope that this conference is the beginning of a process that will ultimately result in a consensus solution to Vermont's unique issues and concerns regarding the future of its public pension and health care plans. And with that, I am now honored to introduce the president of Champlain College, Don Lockman.
Welcome to Champlain, and I want to thank John Pelletier for his leadership of Champlain Center for Financial Literacy. The center works to help increase financial knowledge and sophistication through programs for K-12 students, college students, educators, and citizens. And John publishes report cards on financial literacy by state on a periodic basis, and just came out with a report card that measured the financial sophistication and literacy of adults in states based on their credit histories and other factors. This past summer, the center sponsored a summer institute to train Vermont high school teachers to teach financial literacy to our young people so that they can make better financial choices. We define financial literacy as the ability to manage financial resources effectively for a lifetime of financial well-being. And financial literacy doesn't apply just to individuals. It also applies to state government. I moved to Vermont from Illinois, a state with significant governing challenges. And I share a quote from one of Moody's latest reports on the state when they downgraded their credit yet once again. The downgrade to Baa3, which is junk status, for Illinois' general obligation bonds is consistent with the state's intensifying pressures from pension liabilities. By our calculation, the state's unfunded pension liability for its 5 major plans in aggregate grew 25% in the year ended June 30th, 2016, to $251 billion. That equates to $20,000 for every person living in Illinois. And Vermont is not immune from this challenge. David Coates, one of our panelists today, wrote in an op-ed in Vermont Digger this past February, "Once again, the bad news is the unfunded liability for state workers and teachers' pensions, which increased by $90 million from 2015 to 2016 when it hit $1.8 billion. In total, the combined unfunded liabilities as of June 30th, 2016 is $3.6 billion, or $5,800 for every resident of Vermont. For comparison purposes, the total net tax-supported debt for the state as of June 30th, 2016 was $637 million, or slightly over $1,000 for every Vermont resident. We welcome you to join this critical discussion on how Vermont can both honor its promises to pensioners while preserving the economic well-being of all of our citizens. And I can think of no better person to kick off this discussion than our governor, Phil Scott. Governor Scott has been a leader in bringing fiscal discipline to our state, and he agrees with the importance of finding a Vermont solution to our issues to make sure we are being fair to taxpayers and honoring our commitments. Please join me in welcoming Governor Phil Scott.
Thank you very much. Please, sit down. Thanks. Unless you're already ready to leave. Thank you. Good morning, and thank you to Lisa and the Vermont Business Roundtable for hosting this event, and for David for the inspiration to get together on this very important issue. Today's event begins another important conversation about my administration's commitment to affordability, economic growth, and protecting the most vulnerable. As I'm speaking, you'll see some slides which will provide a visual for what I'm trying to describe. Let me start by giving you the three numbers that literally keep me up at night: 6, 3, and 1. Every day, when we wake up, on average, there are 6 fewer workers in our workforce, 3 fewer kids in our K-12 education system, and nearly 1 baby born to addiction every single day. We must reverse these trends, and we can if we face our challenges head on and focus on expanding our workforce, because they're the people who buy homes, have families, utilize services, buy products, and then they pay taxes. And all of us here in this room, state officials, business owners, community members, state employees, and legislators working together can make the changes we need if we agree on the goal, align every decision with achieving that goal, and this is really important, know exactly how we're going to measure our progress. On my first day in office, I issued an executive order outlining 3 simple principles that guide my administration in every decision we make to work to reverse these trends of this 6, 3, and 1 trajectory. Does it grow the economy? Does it make Vermont more affordable? And does it protect the most vulnerable? I've asked my cabinet, and I ask you to consider focusing and prioritizing these ideas that accomplish all 3 or 2 out of the 3 at a minimum. So, on this slide, you'll see the key indicators, specific metrics our team will be using to measure the progress we're making on growing the economy, making Vermont more affordable, and protecting the most vulnerable. Because as someone famously said, if you aren't measuring it, you aren't managing it. More importantly, I've asked each agency and department to tell us the 3 to 5 things they can do over the next few years to move these indicators in the right direction, and we're working on those as we speak. We spent the first 9 months of my administration rethinking our processes and focusing on having a clear strategic plan and measurable indicators and specific goals and tactics that are all trying to reverse this 6, 3, and 1 trend. Here's one small but powerful example. As part of our pivot program to modernize state government and give more state employees the tools they need to support continuous improvement, we are training employees in lean techniques. In the previous 3 years, about 300 state employees were trained at a cost of about $650 per training day. And in just 4 months, by prioritizing this work and leaning the training system itself, we've trained another 250 state employees, and we're on track to have about a quarter of the workforce or more trained in lean by 2020. I think everyone in this room is aware that as a state, we literally can't afford to keep doing the things we've been doing them. But here's another way to look at it. If we want to protect the public investments we value, and if we want to make more of them, we must reverse the decline in our workforce. The slow growth in Vermont's economy, the decline in Vermont's working-age population, and tightening labor market conditions don't allow us to be complacent. Everything we value and everything we aspire to do is at stake. In July, I traveled to New York City with Treasurer Pierce, members of my cabinet, our state economists, Jeff Carr and Dave Coates, chair of the Capital Debt Affordability Advisory Committee. We were there to meet with 3 different rating agencies to discuss Vermont's economy and whether Vermont was doing what was necessary to maintain its AAA bond rating. I believe it's critical that we meet face-to-face with these rating agencies to tell them that we understand our challenges. I also want to make sure that we share our vision and goals to meet those challenges and to underscore that my administration continues and strengthens the fiscal management the rating agencies have come to expect. What we told them was that we, as a state, make fiscal decisions around consensus economic forecasts. We maintain sufficient reserves. We honor the recommendations of our Capital Debt Affordability Advisory Committee about how much debt we can afford when we issue those general obligation bonds each year. We roll up our sleeves, we work together to address our challenges. And I told them what we had done in the previous 8 months to begin to reverse the trends of 631. We passed a truly historic budget that for the first time in memory didn't add new taxes or fees, providing struggling Vermonters with a small amount of relief and an opportunity to keep more of what they earn. We worked successfully to find efficiencies and $5 million in administrative savings across state government, on top of the $12.5 million in recessions in the fiscal year 18 budget, without deep program or workforce cuts. We also struck a deal on the $35 million housing bond, which began to address the expanding stock of decent, affordable housing for working families which they can afford. A resource we need to help attract families and young professionals to come work and live in Vermont, and an investment that creates hundreds of trades jobs. I asked for increased investment in early child care and learning for the same reason. And you can expect me to continue to advocate for a unified cradle-to-career education system that I believe can be the very best in the nation. We also made some investments in small business development centers, in regional micro-business programs, and in economic development marketing. And downtown tax credits were increased, and several additional TIF districts were authorized to support development. And fortunately, the rating agencies were convinced that we are taking the right, proactive, aggressive approach. But those ratings also came with some sobering, but not surprising, warnings that underscore the challenges we face here in Vermont. The fact is, Vermont's economy is growing, but only slightly, and more slowly than the average economic recovery across the United States. 2017 statistics currently show a decline in overall jobs, tightening labor market conditions, and personal income growth that is painfully slow for families. When we compare Vermont to other AAA states, we find ourselves consistently in the rear of the field. And as a race car driver myself, that's not a great place to be. Vermont's percent of change in real GDP growth per capita was the 4th lowest compared to the other 15 AAA states. 1.91% in Vermont compared to 8.15% in Iowa and 11.25% in Texas. The median household income growth in Vermont is likewise well below that of other AAA states, with a percent change of only 4.4% between 2011 and 2016, compared to the more than 8% growth in top-ranked AAA states. And finally, and again, this is the biggest issue we face, Vermont's workforce has dropped significantly below other AAA peer states. In the last 5 calendar years, the percentage of change in our civilian labor force dropped to negative 4.4%. Our workforce is shrinking, and this demographic is clearly of concern to the rating agencies, and to me and my team, and I believe to many Vermonters. And reversing it should be the top priority of every elected official, regardless of party or philosophy. We must grow our working age population and increase the size of our workforce in order to expand our tax base and invest in our future. To illustrate our population and demographic crisis in a different way, Vermont has 25,000 fewer Vermonters aged 20 and under than we did in the year 2000. We now have 60,000 more Vermonters over the age of 65 than we did in that same year. We also have the second oldest population in the country. And for the next decade, if we do nothing, this demographic trend is expected to continue, with our population share over 65 expected to grow at a faster rate than the U.S. as a whole. Of equal concern to the rating agencies was Vermont's debt profile. Thanks to the great work of Treasurer Pierce and Dave Coates and the rest of the Capital Debt Affordability Committee, Vermont is noted for its sound debt management. But despite that management, our demographics are working against us in this area too. While we experienced a steady decline in our general obligation debt from the mid-90s to 2008, our debt obligations are growing while our population is basically stagnant and actually declining a bit. While the average debt per person declined by $120 since 2013 in other AAA states, Vermont's debt per capita rose by $257 during the same period and is projected to grow in the future. Similar trends are apparent in the 0.3% increase in Vermont's debt as a percentage of personal income. And Vermont's debt as a percentage of gross state product decreased to 2.2%, while the AAA average declined to 0.4%. The point is, Vermont is moving in the wrong direction in comparison to other AAA states. The rating agencies are monitoring these trends, and we need to address them. While we work to expand our workforce, decreasing individual tax burdens, including the debt load Vermonters bear now, is essential. Finally, and what brings us together today, is a third economic caution from Wall Street: Vermont's above-average personal liabilities, or pension liabilities. The difference between the money we set aside to pay retirement benefits to dedicated public employees is much less than the benefit the state has promised to pay them. To our credit, the state has worked with the beneficiaries of the state and teachers' retirement systems to negotiate changes in benefits, contributions, and actuarial calculations. But market losses and other factors have not allowed us to keep pace with our obligations. Vermont's pension liabilities per capita are the second highest amongst AAA states at $5,873 per capita, topped only by Maryland. Our next pension liabilities as a percentage of personal income and gross state product are more than double the average of other AAA states. While we continue to struggle to fund our existing retirement plans, which will be much easier when we start growing the private sector workforce again, we must start the same conversation about whether maintaining the approach of the past is the right direction for our future. We need to take the same pause with these plans as we have with taxes, fees, and property tax rates, and think about what we're doing, because we're in a hole and we need to stop digging. I would describe myself as a realistic, pragmatic, but optimistic Vermonter. And I know we can and we must deal with these issues and reverse these trends. But we, as a government, must find workable solutions with a greater sense of urgency and a greater focus than ever before. I'm grateful to everyone in this room who took the time to be here today to have this very tough conversation. We need to have this conversation with Vermonters for Vermonters. You being here shows you're willing to listen, and I hope today's discussion will help pull us in the same direction, because when we do, the result will be powerful. I want to thank you for coming again. I hope you have a very productive and informative day, and I look forward to working with you in the future. Thank you very much.
Thank you again, Governor. Good morning, everyone. I'm Lisa Ventris with Vermont Business Roundtable, and on behalf of our board and our membership, I want to welcome everyone here this morning for this very important conversation. I would first like to, though, thank our sponsors who helped us to produce today's event: Green Mountain Power, National Life Group, and People's United Bank. Thank you all very much. I have a couple of housekeeping notes before I introduce our keynote speaker. So if people are looking for a Wi-Fi link, if you find the students link, that will take you to the world of the internet. And we will also have our slides from today available on the Roundtable's web page. And Shara, yep, we've got that all good to go. So green light on that. It's vtroundtable.org. I'd also like to thank Shara Bourget, because she is the force behind this entire event today, who has wrangled all of our people and our talents and our materials. So Shara, who is a very proud Champlain College alumna, thank you on behalf of all of us. Appreciate it. And lastly, I want to thank all of our speakers here today. We've invited a wonderful panel of very knowledgeable speakers who can help illuminate this topic, and we hope you will find time also during the course of today, if you stay for lunch, to chat with them and continue the conversation. So with that, then, let me begin my introduction for Greg Mennis. We are so delighted to have him with us today. Greg is Director of Public Sector Retirement Systems at Pew Charitable Trusts. It is he and his team that provide cutting-edge research and help states and municipalities to understand the issues and the options that they have available to them through evidence-based research on pension and retiree health care reforms. Prior to his work with Pew, he's served as Assistant Secretary of Fiscal Policy in the state of Massachusetts. He worked for 15 years in corporate finance and strategy and as a chartered financial analyst. He received his bachelor's degree in finance and communication from Syracuse University and holds an MPA from the Kennedy School of Government at Harvard University. So it will quickly become evident to you that this man is a leading expert on what some describe as the world's most boring topic, and that of unfunded pension liabilities. However, all kidding aside, because public pension obligations rank among the most significant fiscal challenges facing states today, we are delighted that he'll help us understand this a little bit better. Consider the headline on this article from Democracy Journal entitled, "The Monster Eating Our States and Cities." in which the author cautions that, quote, "the house is not on fire, but the walls are crumbling." Therefore, the Center for Financial Literacy at Champlain College and the Vermont Business Roundtable believe that it's important to have an engaged and well-informed public on this topic to understand its implications and best available policy options going forward. One of our goals is to move the public from being bored with this topic, and I want to give props to David Coates, who for the last decade has been the voice of concern on this issue. So we want to move the public on this issue to become more financially literate on unfunded pension liabilities, to become more engaged and knowledgeable about the future sustainability of our programs. And so going forward from today, we hope as well, one of our goals as well is that you will have more information and will feel more comfortable talking about this within your spheres of influence. We've asked Greg to talk about trends across the country, to examine how how Vermont rates in this assessment against not just our AAA states, but around the country, and to share with us a menu of options that policymakers might evaluate as we go forward here to serve both public employees and taxpayers. And then following Greg's remarks, we've got plenty of time for a robust Q&A session, so we hope that you will not be shy. So with that, would you please give a warm Vermont welcome to Greg Mennis.
Thank you, Lisa, for that kind introduction. I also want to thank the college and the Business Roundtable for having us here today. Certainly we're honored to be following on the governor's remarks. And before I get started, I wanted to share a little background about how we came to be at this presentation this morning. When Lisa and David and the team first reached out asking for our assistance in looking at Vermont's public pension system, our first reaction was, of course, we'd like to help. And my second thought, and I think I expressed this pretty clearly, was just sharing the reaction that nobody thinks of Vermont as a problem child in this area. And I think at the moment we were speaking, we were finishing a report on the city of Detroit's pension system and completing a reform in the state of Pennsylvania that saw an $80 billion swing in their pension deficit in the course of a decade. These are places with really deep, intractable problems. But as I said, I was happy to engage in the conversation and went to that thinking of Vermont as a place that understands and knows how to proactively address policy issues. And when we had the first discussion, because it's the world's most boring topic, what we typically try to do is just wade into things step by step and talk about some of the basic ideas that we see in the field, what some of the key numbers are and some of the ideas that people are considering. And I found myself in the course of a conversation that I think ran an hour, consistently being challenged by everyone on the phone, clearly demonstrating they understood the issues that we were focusing on, asking really good questions. And I came to realize towards the end of it that we were being engaged in this process where Vermont knows how to proactively address policy issues. And so we're really excited and honored to be part of that. And as an extension of that, I don't know that we've ever seen a presentation by a governor that says, you can't manage what you can't measure, which kind of gives us chills and makes us feel really good. So with that, I'm going to try to jump into this. Great. So in our presentation today, I'm going to give a brief introduction into the work that Pew does in the public sector retirement system space. And then we're going to walk through our research and analysis in three key areas: pension funding and fiscal health, pension investments, and benefit design. This is really where all the economics exist in this important topic. As we go through each of those categories, we're going to spend some time talking about our 50-state research and some of the trends that we see, and then pause as we go to put Vermont into context as best that we can. In the course of the discussion, I would say that there's three themes that we're going to try to draw out. The first is our view that public sector retirement systems are as vulnerable as they have ever been to an economic downturn. 8 years after the Great Recession, fiscal solvency has largely stabilized for public pension systems, but we haven't seen a recovery or an improvement relative to where things were before the Great Recession. The second point I would say is that Vermont's challenges are fairly typical. For the most part, the state ranks in the middle of the pack in all the measures that we look at. A slightly lower funded ratio, a slightly lower rate of performance on investments, but stronger inflows on the contribution side and some other factors that put the state kind of in the middle of the pack. And then the third issue is that we see some emerging trends and themes around stress test reporting as a way to carefully address and analyze many of the economic factors and issues that have already been discussed this morning, and also some very innovative ways to think about public sector benefits in a manner that actually preserves a component of a defined benefit plan that can provide public workers with retirement security, but does a better job of managing uncertainty and risk on behalf of taxpayers. The Pew Charitable Trust is a nonprofit philanthropic foundation. We have more than 40 active projects in the area of government performance, ranging from public pensions to public safety, immigration, elections, and transportation. All the projects follow a very common data-driven approach. We do 50 state and multi-city research on every issue related to public systems in our project, and then we also provide technical assistance to cities and states. That technical assistance is something that the project has been doing since 2011, and some of the recent and current engagements include Connecticut, Pennsylvania, South Carolina, Virginia, and Milwaukee County. In every single instance, with the exception of Milwaukee County, because that's a newer project, we have been part of advancing what we think are very innovative and forward-looking reforms. The way that we go about our work really takes two big ideas into account. The first is that there is no one-size-all-fits solution. We understand that in the state of Vermont, the solutions on public pensions and any other policy issue need to be Vermont solutions. At the same time, I think we also find that key principles can apply to how we think about and go about our work. Those principles we put into two broad categories, the first being around fiscal sustainability, making sure that pension systems are affordable, sustainable, and secure both for taxpayers and for public workers. And then secondly, retirement security principles to ensure that the benefits being provided meet workforce goals to provide retirement security for valued public workers. These are very high-level concepts, but I assure you that a lot of thought has gone into where we landed on each of these points. And in the course of any conversation, perhaps even later today, you will find that we will fall back on these principles. On the fiscal sustainability side, it all starts out with a commitment to fully funding the pension promises that have been made to public workers. We talk a lot about managing investment risk and cost uncertainty. Again, an issue I'm delighted has already been brought up this morning. Sound governance practices are a way to provide information to ensure that you can both manage and measure pension costs and liabilities. And the retirement security principles side really speaks to whether enough money is being set aside, whether the investments are being done in a professional manner that is pooled and low-fee in nature, and whether they have a plan in place to generate retirement income by converting assets to an annuity stream upon retirement. So as I said before, in each case, I think we can fall back and talk to these principles in the course of our conversation. I would also say, in honor of the no one-size-fits-all principle, we do have some pretty clear ideas on what we think policymakers in Vermont might consider. We've been careful not to overstep our bounds and put those on paper in this presentation. But if anybody happened to ask me a question about what a 5-point plan might be, in the Q&A section, I'd be happy to lay that out. So the first area of research we're going to go into speaks to pension funding and fiscal health. Before we get started, a few common definitions when we talk about pension systems. The first two are actuarial measures that anybody who's been somewhat close to the topic is probably familiar with. The first being the funded ratio. That's simply the comparison of assets to liabilities, the amount of money that's been set aside to pay for promised benefits as a percentage. The annual required contribution is a calculation that each state actuary does to ensure that sufficient funds are being set aside to pay both for new benefits and to pay down any unfunded liability. The financial metrics reflect what we think is a more advanced way at looking at some of these issues. It gets a little bit technical, and I'll try to build towards this as we go through the presentation. Net amortization to payroll, I think the shorthand for that is it's a better measure than the ARC to assess whether or not the state is putting aside enough money each year to pay for public pensions. Our measure of this is very similar to what Moody's does, the rating agency, and what they refer to it as a treading water benchmark. And what it does is answer a very simple question. If plan assumptions are met, including the assumed rate of return in a given year, is the money being set aside through contribution policy in each state sufficient to prevent the unfunded liability from growing? I know that that's a mouthful, but I think it's just a way to think about, are you paying enough into the system each year? Operating cash flow to assets is something that we've been looking at very closely, and we'll be presenting on at conferences next week, both in the Netherlands and at the Harvard Kennedy School as part of a bigger project on stress testing. And it looks very simply at whether the cash flows for particular states provide an indication of the risk of fiscal insolvency. Vermont definitely does not fit into this category, but we're finding that states like New Jersey, Kentucky, and Colorado have genuine risks of having pension systems go insolvent. And in fact, in the state of Colorado, the system did their own report and made public statements to say that if there's an economic downturn, this is a real risk. That's a big development in our field. Nobody has been talking about that with hard numbers to support it up until recently. Some of the headlines as it relates both to the 50-state perspective as well as Vermont. There's over $1 trillion of unfunded liabilities based on how states and cities report their numbers for pensions. We also track the unfunded liabilities associated with retiree health care. Recently put out a report at $645 billion is the latest figures. As I said before, Vermont ranks in the middle of pack on most of these metrics, a little bit lower on funding and investment performance, a little bit stronger on some of these measures of contribution adequacy. And on the state's operating cash flow to assets ratio, which again we'll talk about a little bit more in a moment, I think that this is an indicator that Vermont is not one of those states, again, that is at risk of insolvency. But like everywhere else, I think attention is required. We talk a little bit more about the retiree healthcare liability as well, and I'll put that into perspective shortly. This next slide shows the funding gap for 50 states based on the numbers as they are reported in each state's CAFR, its annual financial report. It shows the difference between pension assets that have been set aside to pay for promised benefits and the size of those liabilities themselves. Based on our last report in 2015, we saw a gap of about $1.1 trillion. By itself, I think this gives us a starting point to think about the issue, but it's somewhat limited. I think we need to answer the question, why do unfunded liabilities matter? One point we would say is that over this same time frame, the amount that states have been paying into their systems has just about doubled. The ratio that we look at are the pension contributions as a percentage of state-owned source revenue, figures that are produced annually by the federal government. By that ratio in aggregate, states have gone from about 4% to 8%. So I think that's a clear indicator that costs have been rising. This next slide takes similar information with two different changes to it. What it shows is the unfunded liability or pension debt as a percentage of U.S. gross domestic product. The differences are we also include municipalities for this purposes of this calculation, which again is taken right from the federal government websites. And we use GDP just as a point of reference to try to put the unfunded liability in the general context of the resources available to pay, speaking to some of the issues that you all are thinking about in forecasting future economic growth and revenue. And as we say here, and I think what's interesting is that the debt to GDP ratio has spiked up, as you might have expected, at the time of the Great Recession. And although there's been some back and forth with that, it's pretty much stayed at that level at about 8% above GDP. And if you step back a little further, I think what's also interesting is that the other biggest spike that occurred happened around the time of the dot-com crash. And this is where, coming out of the bull run in the stock market of the 1990s, where the S&P returned about 18% on average, and going into 2000, when state pension funds reported a 100% funded ratio on average, that big loss in the stock market led to a deterioration in fiscal position. But even in the time frame where there was recovery before the Great Recession, you can see that the level of pension debt to GDP didn't improve. So we've seen two economic shocks where things have leveled out but haven't gone back to where things are better. And so I think this is the first indication from our perspective that states are as vulnerable as they ever have been from a pension perspective to an economic downturn. This next slide shows the picture for Vermont with the same information. What we see here is Vermont was one of the states that was very close to being fully funded for an extended period of time. And then coming out of the Great Recession, we see a picture that's very similar in a number of different jurisdictions. Things have stabilized, but for two reasons: lower investment returns, and Vermont has underperformed its peers in that regard, and contributions that have been sufficient to tread water but not really pay down the debt. Lead to the funding gap that we see today based on state reported data. This next slide just gets a little bit into the details of the funding policy that the state is currently following, the rules that are set in place to decide each year what the actuary recommends for contributions into the system. I won't spend too much time on the details of this, and if you look at the very bottom line, I would say that this is a very typical standard approach that most states are following today, which is a payment plan that targets a full funding date somewhere between 20 and 25 years. So Vermont is right in the middle of the pack in that regard, is certainly not one of the states that's being irresponsible on this front, and at the same time is not one of the states like North Carolina or Wisconsin, for example, that have aggressive funding policies that help to keep their systems fully funded. Just to put things a little bit into a regional context, we look here at the funded ratios for New England plus New York. This is based on 2015 data as the states have reported them. In certain cases, we're about a year behind, and that's only because we are meticulous in going back and checking with every single state to verify the numbers that we produce in our reports. The 16 figures don't look very much different, and as you see, Vermont, again, is kind of in the middle of the pack. The state of New York has an absolutely rigid actuarial funding policy that has maintained full funding for as long as our data goes back. You may be familiar in Maine that they passed a constitutional amendment, and Maine is actually one of two states, along with West Virginia, that have seen the greatest improvement in the fiscal health of their system since the year 2000. Connecticut and Rhode Island probably get the most attention as the New England states with the biggest challenges, and we'll talk a little bit about some of the innovative policies that Connecticut is trying to achieve. To broaden this out a little further, I think one of the points we want to draw out is that the fiscal health of pension systems across the 50 states varies dramatically. And here again, we see Vermont kind of falling in the middle of the pack. Let's see if I can do this. Bear with me just a second. Did we lose the link? Sorry. Oh, there it is. Okay. So since this is the world's most boring topic, I think we're going to try to give people a cup of coffee here in the form of some visual aids that we've looked at. I'm going to try to walk through this really carefully, then push a button and see whether the animation helps tell a story here. What this chart shows on the left-hand side is the funded ratio, the percentage of assets that have been set aside to pay for promised liabilities. Going from left to right, what we see is the percentage of the ARC payment, the annual required contribution that has been made. So across these two dimensions, we get information about how different states fare in terms of their fiscal position, or their funded level, which goes from bottom to top, as well as their fiscal discipline, how good they are at following through on paying their bills based on what actuaries recommend. We've selected 10 states here. We're starting with the year 2000 to include New England along with New York. I've added Pennsylvania and New Jersey, two states that have had really big challenges, and also included California as something of a benchmark for the country in total. So we see as a starting point for 2000, most of the states were somewhat above full funding. New Jersey's an interesting example because they were 110% funded as of the year 2000. And this line right here shows that on average, the states were essentially full funded. What's interesting about New Jersey and what this information is telling you already is that even at the year 2000, they were already getting in the habit of not paying their bills. We see that because even though their funded ratio is above 100%, the amount of money that they were paying relative to what was required was only about a third. And Vermont, I think, as you can see right away, is on the right-hand side of the screen. I hope that folks can see this. And really falls about in the middle in both regards. Pretty close to full funding at 2000 and paying about 95% of its ARC payments. And then if we watch the timeline, we can just see how the different states have moved across the pack there. You see New Jersey falling. You see Pennsylvania racing to catch up with them in terms of having a negative fiscal position. California, again, falls right on this line of average funded ratios of a little bit above 70%, and Vermont is very close by. So I think the takeaway point is, consistent with no one-size-fits-all on solutions, there is no one-size-fits-all story about where different states are or how they've gotten there. Pennsylvania and New Jersey really went out of their way to not pay their bills for more than a decade. In the case of Pennsylvania, they've taken very swift and drastic action, and I think are back on the path to fiscal solvency. New Jersey is a different story, and as we'll talk about in a moment, is probably one of the two states we think is most at risk of fiscal insolvency. Thank you for, that's the first time that we've tried this in person, so thanks for staying with us. Okay, so this next chart shows one of the other financial measures that we talked about before, net amortization, the treading water benchmark that we use to compare states as to whether they are following policies that can be expected to pay down unfunded liabilities over time. I'm going to start by pointing out the good news as it relates to Vermont into context, and then spend maybe just another minute kind of walking through what this is actually telling us. What all of the states with the green bar show on the right-hand side of the page is if they achieve their assumed rate of return in a given year, and the other actuarial plan assumptions are essentially met or in line, they can expect to see a reduction in unfunded liabilities year over year. That's important because as unfunded liabilities shrink, the resources available to pay for other government core services increase. So in this regard, Vermont is on the green side, which is good news. And it suggests that if those assumptions are met, it will be able to pay down the unfunded liability each year going forward. And then if we want to step back and talk a little bit about the plan design for the system, what we'll find is that the Vermont has a very traditional defined benefit pension plan, and I think that also factors into the thinking and how we look at things. This next slide talks a little bit about average cash flow. We look at benefits minus contributions as a percentage of assets. Again, I'm going to walk through this pretty slowly, step by step, and put Vermont into context and also call out some of the states that we see having the biggest challenges. So what the bars show is the funded ratio. It's the same calculation that we looked at before, just presented a little bit differently. And moving from left to right, we see South Dakota as the best funded plan, along with Wisconsin, New York, and North Carolina. These are always the states that have done a good job of keeping their systems fully funded. And then trailing all the way down to the right-hand side of the page, we see Kentucky and New Jersey on the right. What the red dots show is the measure of operating cash flow as a percentage of pension assets. Long story short, what this means is for, if you look on the right-hand side of the page, that Kentucky and New Jersey have negative operating cash flows of above 6%. What that means is if they don't achieve rates of return on a consistent basis above 6 or 7%, their asset base is going to decline. It's not just a deterioration in their fiscal position, but they're literally going to be heading towards a path of insolvency. If you look at downturn economic scenarios, such as what the federal government asked banks to examine in the Dodd-Frank situation, you see sharp declines in asset levels where states like New Jersey and Kentucky would enter into a death spiral. They would literally see assets depleting at a rapid rate towards the path of insolvency. Colorado is also on the right-hand side of the page. I mention this again because Colorado did a study to show that in the case of a recession, insolvency was a real risk, and they're not even in the worst position. So this, again, is additional evidence that state public systems face the biggest challenges as perhaps they ever had. Vermont, I think there's generally some good news here, and I know that it's difficult to see, but if you look at their cash flow ratio, it's negative 2%. It's better than most other states. And what that means, again, is that there's a sufficient amount of money going into the system that should pay down unfunded liabilities over time. And in addition, there's a sufficient amount of money going into the system that if we saw a recession, I think this insolvency risk is not something that's a factor for Vermont. I know this is a lot of information. I'd be happy to come back to this later in our discussion. Yeah, I was going to. Sorry about that. Right here. Does that help? So the funded ratio we've already talked about. And then if you go to left to right, what that shows is it's still a negative operating level of negative operating cash flow. The amount of contributions going in is still less than the benefit payments going out, but the benchmark rate of return is only about 2% or a little bit less. Essentially meaning that the state could choose to invest in risk-free bonds and still see an improved asset level. So I think that's generally good news for Vermont. But at a national level, this is the most risk we have ever seen in these numbers if you go back to 1997. This next chart is another national perspective in an attempt to look at the same issue in a slightly different way. What it shows is the blue bar are the benefit payments that are going out for all state and local plans across the country. and the mustard colored bar shows the amount of contributions, the inflows that are coming into the system. And what we see is that the benefit payments have been and continue to grow slightly faster than the contributions going in. That gap between the two things, that's the negative operating cash flow issue. And at the same time, asset levels, measured as total assets to the benefit payments, it's another indicator of insolvency, dropped off significantly as we saw in 2008 and have largely been kept flat. So this again is one more indicator to show that coming out of the Great Recession, as everybody knows, we saw a significant deterioration in the fiscal health of public pension systems. Any measure we look at, things have stabilized, but they haven't improved or returned to pre-recession levels. If we go back to the dot-com downturn, we see that this is the second consecutive recession where things have stabilized but not returned to prior levels, and therefore we say there's more exposure than there ever has been. To shift gears a little bit, this next slide just looks at retiree health care benefits, or OPEB. The measure we use here is the total retiree health care liability. That's the value in today's dollars of all the commitments that have been made to public workers to pay for retiree health care when they're done working in public service. And we compare that total liability to each state's personal income. I think this is consistent with the conversation this morning talking about the trajectory for Vermont's revenue and economic growth. Personal income is just an indicator of resources available to pay. As you go from left to right, what we find interesting in this slide is that on the left-hand side of the page, there's about 25 states that have the highest ratio of retiree healthcare liabilities to personal income. The reason that they're all in blue is that those states all follow a pretty similar structure in terms of the benefits they deliver, which is a percentage, sometimes usually approaching between 80 to 100% of healthcare healthcare premiums or supplemental benefits for Medicare age retirees. We see Vermont right here is higher than most other states. The main reason they're higher is because they provide this very significant benefit, a percentage of premium contributions. That becomes more expensive from the state's perspective for two reasons. One is that the commitment to pay for full benefits by itself, as opposed to just giving a fixed dollar amount, which is what the states on the right-hand side do, or nothing at all, which is what some of those states do, is more significant to begin with from a cost and benefit perspective. In addition to that, those benefits typically grow with healthcare cost inflation. So long story short, the states on the left-hand side of the page are offering retiree healthcare benefits that are exposed to the uncertainty of healthcare cost inflation, and so the liabilities for those states are greater and have grown faster over time. Are there any questions on this? I hope this gives a general sense of the retiree healthcare piece, which we can talk about later. The second topic from a research and analysis perspective, again, we'll give some national information and talk a little bit about Vermont as well, has to do with pension investments, and I thought there was a great introductory discussion discussing the fact that interest rates are expected to be low for an extended period of time. National and global growth is expected to be lower than it ever was, and as a result, every forecast we have seen is bringing down the rate of return assumptions for public pensions. To provide a bigger picture and step back a little bit, the first thing we start with is just looking at what the trend has been, where pensions have moved out of safe investments like bonds and into stocks for a period of about 50 years now. Over the past decade, the interesting development we have seen is a shift towards alternative investments, real estate, private equity, and hedge funds. And the percentage of investments invested in those categories has gone from less than 10% to more than 25%. So there's been a longer-term trend towards stocks in an effort to generate higher returns, and there were more recently a shift to higher cost, more complex investments. There are examples of states that have done very well in that regard. There's also a lot of evidence that states have struggled to make hedge funds work from both a cost and performance perspective. Vermont's rate of return is lower than its peer group in the way that we analyze this, but I think it's really important to point out that the state also has a lower risk profile with a much higher percentage of investments in bonds and a lower exposure to the stock market than most every other state in our study. I think that that's a well-reasoned strategy, provided that it fits in with the other pieces of how the state looks at public pensions. And here again, I think this is the one place where we would go so far as to put the word recommend. That that stress testing and analyzing carefully how pension finances may play out, given uncertainty in the financial markets, I think is essential for every state. This picture shows the long-term trend I mentioned a moment ago, going back all the way back to 1954, where over time states have progressed towards portfolios that now have a total of 75% of assets in stocks and alternatives. Right now it's about 50% in public equities or stocks, 25% in alternative investments, including real estate, private equity, and hedge funds, and the balance in bonds. Some of you may be familiar with the storyline here where there were really two factors. One was the advent of modern portfolio theory as applied to public sector investing gave people more information to think about the value of investing in stocks for the long term. And in most states, there were reduced restrictions on permissible investments. Going back to the 50s, most state laws prevented public pension funds from putting money in anything other than very safe corporate bonds and government bonds. This next slide provides, takes that information and tries to put this in the context of what this means in terms of states' risk exposure. What the orange line on the top shows is the average assumed rate of return and how that's changed over time, going back to 1992 for public pension funds. Back in 92, the average rate was a little bit above 8%. Today, it's about 7.4%. So all things considered, that line has been relatively stable, particularly in comparison to the yield on the 30-year Treasury bond, which is the jaggedy blue line at the bottom. The Treasury bond is relevant because this is seen as the benchmark for risk-free investing. And as a result, what financial experts look at is the difference between the target rate you're trying to achieve for your investment portfolio and what could be achieved if you just invested in corporate bonds. So that gap, which we call the equity risk premium, has been as large as it's ever been. And so when we talked about the fiscal position, looking at funded ratios and cash flow ratios about where states are today, this to me is the first bit of information that helps us to start looking forward and just be attentive to the fact that financial market volatility, given where states are invested, is an important consideration. And we see that volatility demonstrated in this next chart. What this does is compare the year-over-year rate of return for public sector pension systems on average. That's the purple line. Tux is the reference point for that, as compared to the S&P 500, the stock market, essentially. I think this is really interesting because it shows something we might expect, which is public funds track the stock market. The stock market is going to go up and down. It is going to be very responsive to economic downturns or periods of high growth. And so managing this volatility in the investments and what that can mean for state budgets, I think is of utmost importance. This next chart compares the asset allocation of the U.S. averages that I mentioned a moment ago. About half are invested in stocks, with the other 2/4 split between bonds and alternative investments, to where Vermont is today. I would really draw out two issues from this perspective. What we see in the green slice of the pie on the right-hand side, based on our calculations, is that the state has about 1/3 in bonds. That's noticeably higher than what other states do, and a much lower exposure at 36% to the stock market. The classification of alternative investments, which here we have at 31%, is something that varies from state to state to state. We try to do this in a consistent way and also ask states to verify the data. What it includes is real estate, private equity, and hedge funds. And I think in the case of Vermont, it's important for me to point out that also includes investment strategies that could be reasonably be reallocated to the stock and bond categories. So the point I'm trying to make is that each state reports this information a little bit differently, and all things considered, Vermont has moved towards a lower risk investment portfolio, which should have lower levels of volatility than we saw in the last slide. As part of that shift to a lower risk portfolio, we have seen that the state has performed lower than the other states that we look at in our 50-state study of pension fund investing. This group of states follows a group that all report on a fiscal year basis, that's June 30th, with results that are gross of fees. That means that's before the performance figures don't deduct the cost of the investment managers. I wanted to touch upon this information and identify it as important, not so much from the perspective of pure performance. As I said before, a lot of this is a reflection of the state's lower risk and lower exposure to the stock market, which by and large has done well coming out of the Great Recession, but more as something to think about when the state considers its assumed rate of return on pension investments and its overall fiscal strategy. with all these big ideas in mind, I think one of the emerging trends that we've seen is something called stress test reporting, which is a requirement that states are beginning to adopt, that in addition to the actuarial valuations and the financial information that each state is required to present in under the Government Accounting Standard Board requirements for financial reports, that there is additional work done to analyze pension costs and liabilities under different investment return scenarios in order to help policymakers think ahead from uncertainty or consider what the impact of different reform options might be. This is part of a general strategy where states are increasing contributions to account for higher levels of investment risk. In certain cases, modifying investment return targets and or asset allocation. This is something that we've seen in Vermont on the asset allocation side, moving towards something that's lower in risk. And we've seen a rapid reduction in the assumed rate of returns across multiple states, or implementing changes to plan design, which we'll talk about shortly. But the bottom line for us is that we think that stress testing investment returns so people can understand not only the actuarial expected results for the pension systems, but what it might mean for beneficiaries and taxpayers and the state budget if investments underperform, or if there's another economic downturn, is absolutely essential. The Society of Actuaries Blue Ribbon Panel offered up a recommendation back in 2014 that I think gave everybody a really helpful foundation to think about this issue. We note here that California and Washington State have been doing this kind of work for a number of years. Hawaii and Virginia have adopted formal policies. We help write both of those, working with them. And I mentioned before that Colorado is now doing stress test reporting on a regular basis as well, and has done the best job, I think, of identifying this issue of insolvency risk. This next slide is something of a preview to work that we're going to be doing going forward. And what it shows is the stress test simulation model that Pew has created to help cities and states better understand what the financial projections may look like under these different scenarios. So I thought I would just spend a minute on this, giving people a sense of kind of how this work gets done. On the left-hand side of the page, the inputs into the model include the actuarial projections, the capital market and asset allocation assumptions, that's forecasting out what we think investment returns might be under different conditions, and also state revenue forecasts, where the consideration of economic growth state by state by state is really important because that shows differences in states' abilities to pay. On the actuarial projection piece, I wanted to note that our efforts in this regard are to replicate as closely as humanly possible the projections that each state actuary uses. We have found that every state's actuary understands their pension system better than anybody else possibly could, that coming up with a set of numbers that's consistent is helpful from a communications perspective. Getting into debates about whether this or that or the other assumption is correct is not productive and wastes important time. And so we do our best job to mimic those numbers as closely as possible. And on the capital market and asset allocation side, we have a very sophisticated point of view where we've looked at the bottom up of national GDP growth and what we forecast for each of the different asset classes. And what that allows us to do is to analyze investment returns in a consistent fashion across the different states. And the state revenue forecasts, I think, is really spot on with some of the things that were discussed this morning. We actually look at the projections for gross state product as a very high correlated proxy for how state budgets are expected to grow over time. And then on the right-hand side of the page, it just talks a little bit about some of the outputs we see from this. So we think this is a powerful tool, an important approach. As I mentioned before, there are now 5 states, actually, that have adopted this approach to analyzing their pension system. And 2 other states, Connecticut and New Jersey, have legislation that they're currently considering. And we will also have a paper that's coming out next week where we do a detailed stress test examination of 10 states. And I think the results are really fascinating. One of the topics we talked about before, and something for Vermont to think about, is the interplay between the changes in the investment portfolio and the assumed rate of return on investments. Here again, I don't want anything to be come across as us saying what Vermont should do or being critical. It's just to point out that there has been a movement, as you see on the left-hand side of the page, towards rates of return that are much closer to 7%. I think we talked about California's going in that direction today. Connecticut went down to 6.9%. Virginia is at 7% already. And so I think there is sort of a downward shift. And Vermont, you can see, there it is, yeah. It's more on the right-hand side of the page. One of the challenges that we see when states reconsider their investment return assumptions is that it can lead too quickly to a sky is falling kind of conversation, because people take that assumption and they plug it into the current actuarial funding policy, and it produces numbers that are drastically increased in terms of required contributions. Our point of view is very different on this. We think that the assumed rate of return should reflect the expected economics. Our view is that stress test modeling is a way to better think about which contribution policies work better than others over time, and also that affordability is an important question. So I think we would definitely point this out as something the state should consider, but we would say that as part of a more holistic review of the state's finances on pensions. And this next slide just gives a little bit of information on that emerging trend around stress test reporting to show the states that have adopted this. In this map, we also include states that have adopted investment fee transparency measures. We put a report out last year that looked really carefully at the differences in how each state reports their pension fund investments. We offered up several recommendations, one of which was complete fee disclosure on private equity investing. Most states today do not disclose the carried interest or performance fees on private equity investments. In aggregate, we estimate that's about $4 billion in unreported fees. And I think we said this in our report, you can't manage what you don't measure. So I think this also fits in with how Vermont thinks about things. On the benefits design perspective, we just start off looking at what Vermont does today. There's a lot of information on this page. This is something we would typically come back to if there were questions. But what it does is it breaks down the different components of the state's defined benefit plan that it offers state workers, teachers, and municipal workers, and provides some information to put that into a 50-state context. I'm just going to talk about one of the items on this list, which is the benefit multiplier. And for those who may not be as familiar, the benefit multiplier refers to the percentage of benefit for each year of service that a public employee is entitled to as a participant in a pension system. The median benefit multiplier across the country is 2%. And what that means is if a teacher works 35 years, they get 70% of their final average salary in the form of a pension benefit. That's the core of the pension benefit calculation. In this regard, I think what we see is that Vermont's benefit multiplier is somewhat lower than average, so the benefit is not one of those that are more expensive than other states, and it's also one of the states, among the vast majority of states, that provide Social Security to public workers. So here again, there's a lot of information on this page. I'd be happy to come back to it if it's helpful. If we step back and think about the issues around benefits design from a 50-state perspective, the first point is that 49 states implemented some kind of benefit reforms between 2000 and 2009, 2015. Vermont is included in that. Every state, with the exception of Idaho, did something to be responsive to the unfunded liabilities that grew coming out of the Great Recession. In most cases, that had to do with adjustments to existing defined benefit models. And in particular, what we saw are reduced cost of living or COLA adjustment benefits, and some increase in what employees were expected to pay going forward. At the same time, 9 states also passed reforms that made significant changes to the structure of the benefits. The most common model is something that's called a hybrid plan. It includes a smaller defined benefit pension with a defined contribution 401k style component that provides workers with an individual retirement savings account. And I'll talk a little bit more about that as we go. So we mentioned before that there are 16 states that have some version of alternative plan. For this purpose, we define an alternative plan as something other than a traditional defined benefit pension. That includes defined contribution plans, 401k style plans in certain cases. The state plan for Michigan and all workers in Alaska receive benefits in the form of a 401k style plan today. The hybrid plan, shown in purple, is the most common. Again, this is a defined benefit pension that's typically about half of what states were offering before, combined with a defined contribution 401k style model. Washington State is one of the states that's called out here with that hybrid plan model. They were the first state to implement this back in the 1990s. And the Washington State model, as well as what most other states do, follows what the federal government did in the 80s. This is a very proven model approach and something that we've been working with a number of states on. With that big idea in mind, the emerging trend we see here on the benefit side is a move towards what we call a risk-managed hybrid plan. So the first point, as we talked about a moment ago, is that the DB-DC hybrid plan is really the most common alternative approach that states have looked at. And the second bullet point, we also know that within defined benefit plans, states have also been adopting what we refer to as cost-sharing measures. In its most basic form, what this requires is that employee contributions adjust automatically if investment returns are higher or lower than expected. We think that's an improvement where policy has been in the past, where the adjustments or the changes to different benefit parameters happen under duress and in a state of crisis and in a reactionary way after the Great Recession began, for example. What the cost-sharing features in the defined benefit plans do is think proactively. And so if investment returns turn out to be lower than we thought, there's a formula built into place where employees have to contribute more to the pension system. And likewise, if investment returns play out to be better than expected, their contribution levels will go down. What the risk-managed hybrid plan does is take this basic DB-DC hybrid model and also incorporate these cost-sharing features on the defined benefit side. This isn't to say this is the right solution for Vermont, but again, I think this is the trend we're seeing in how states have really synthesized some of the most innovative ideas on benefit plan design. Our point is that the risk-managed hybrid, or the RMH, preserves strong benefits that could be full replacement income for career workers, an improved level of savings for non-career workers, and about 75% of public workers typically don't stay on to take a pension, while protecting taxpayers against 50 to 75% of investment risk going forward. We understand, and I think this is true in Vermont, that there's a strong commitment to preserving the pension promises that have been made to public workers, and I don't think there's any discussion about doing something different from that. I think we also see, based on what some of the other states have done, is that there are options that will maintain a defined benefit pension as part of an attractive compensation package, will get most workers to pretty much the same place in terms of replacement income, but are designed in a way that's a little bit more flexible, both for a mobile workforce and to protect taxpayers going forward. And we note here that as of 2017, there are 4 states that have adopted models similar to this in whole or in part. So my concluding remarks on this, the most boring topic in the world, are, as we've talked about before, we think the measures of fiscal health leave states as vulnerable as they've ever been to an economic downturn. We would be happy to debate that point for as long and as much as anybody wants to, because we are not coming this from the perspective of saying that pension systems should be done away with. In fact, there are places like North Carolina and Wisconsin that provide terrific benchmarks of well-funded pension systems that work. But I can't find a set of numbers that tells me anything different than the exposure is as great as it's ever been. The good news for Vermont is that the state is somewhere between average and in certain respects above average in terms of their fiscal position and metrics. And so this is not a case like we would see in New Jersey or Colorado, where insolvency is a real part of the conversation, but rather whether there's an opportunity for the state to preserve its good retirement system and make it better going forward. And as we said before, there's no one-size-fits-all to these solutions. Each state has their own priorities and goals for their public workforce and how they manage their state budget. We talked about key principles that we apply in each case. And also, some of these emerging trends really can give state policymakers a head start about the issues that are most important to think about. That concludes our remarks today. I hope we have some time for questions, and I thank you for bearing with me on this important topic.
Yes, Wynn. Hold on, Shara's coming. So folks, on the table also are 3x5 cards. If you don't want to stand up and ask your question, but you'd like to write it down, we can then feed it to Greg.
So, Greg, I'll follow you up on your invitation to ask you, what are your recommendations for Vermont?
Funny you should ask. If we were to lay this out, we would say that the first step would be to establish some reasonably clear goals about what the state wants to achieve from both a fiscal sustainability and retirement perspective. All of us have been in strategic goal planning exercises, and we know those things are only as good as the effort that's put into them. But I think you can provide a pretty reasonable, you can get pretty quickly to some solid goals to say, for example, We want a path to fully fund our pension promises. We want to follow a contribution policy that protects us against downside risk, defined as a 5% long-term investment return scenario. And so you can put hard numbers against what that policy is supposed to achieve. That we want a pension plan that provides, for example, full replacement income for a career worker and a savings rate of 10% for a non-career worker. I'm giving specific examples really to try to demonstrate that I think there's an opportunity that you could set pretty clear goals that would require some discussion, but something I think perhaps policymakers could agree on or could agree on a range of goals. The second thing is I think that the state ought to consider adopting a stress test reporting framework. The two biggest pushbacks we get on that one are it can confuse matters with the important actuarial numbers that are produced by each system, and that it can be expensive. On the confusion front, I think I made a point of emphasizing that the right way to do this is to use the actuarial projection as a baseline. And then the second point I would say is that in addition to there being nonprofit organizations that can help, in the state of Hawaii, the cost estimate they received for what they wanted to do was $12,000. This is something that can and should be done. The third thing I think is that the state should evaluate the assumed rate of return on investments given the recent change, or not, given the current status of the investment portfolio, and with the benefit of stress test analysis, take a careful, thoughtful approach to calibrating the contribution policy to make those pieces fit together. That seems to me to be a pretty tactical and straightforward issue to consider. And I will say it again, that we don't present that as sort of a thinly veiled way to show that the sky is falling. We just think you can tighten up assumptions and strengthen your policy, and that will lead to better outcomes, and we can demonstrate that. The fourth thing I would say is that a quick and thorough review of what other states are doing on some of the trends that I mentioned, particularly around benefit plan design options, is something that's both worthwhile and pretty accessible. You could, for example, look at Vermont's pension benefits today and compare what they might look like for different public workers, a career worker and a younger worker who may change job, based on some of the different models that are being looked at. And that one we would encourage this comparative analysis because it doesn't make an effort to start with the answer in mind. It's really sort of a standard framework, and we have this published on our website about thinking through the retirement security issues. And the fifth one, and this one is a little bit more open-ended, and I'd love to be educated on that, would be to review the state's retiree health care benefits in the context of what the state is doing as part of national health care reform more generally. I don't have a specific idea around that, but I think the observation we have is that historically states have made these very large commitments to retiree health care. National health care reform happened and is still under discussion, as we all know, perhaps frustrating for many of us because we think it's good policy. I don't know of a state that would be better situated to think about those two issues at the same time and really just to explore, for example, whether there's a path to providing the exact same retiree health care benefit or a similar benefit, but take into account what the national health care reform offers and whether the federal government subsidies could be part of that equation. So those just, for what it's worth, are the 5 ideas that we came up with.
Thank you. You mentioned, Greg, the equity premium, which was the gap between returns on equity and where portfolios are portfolios are actually earning.
Yep.
To the extent that there's a gap between the return assumptions and the real assumptions, and I'm not directing this necessarily at Vermont, but first part of my question is, are anyone's pants on fire to the extent that there is this gap between what the states assume to be earning and what people who watch the markets know can be earned? And as a follow-up to that, coincidentally, there was just an article in the journal you may have seen about the Caisse de dépôt, which has earned a return of about 10.5% per year over the last 5 years, but they actively manage investments. I think they're going to be managing a new light rail system near Montreal. The other Canadian pensions have taken equity positions in privatized airlines, or airports, excuse me. Are there states that are looking at ways to bolster the return by actively managing infrastructure projects?
And I couldn't hear, those are really good questions. I couldn't hear the one part of it. Could you just help me understand the pants on fire?
There is a gap between the announced assumption and the actual returns on many state portfolios.
Right.
Is that just a forecasting error, or is that disingenuous on the part of some state pension managers?
That's an important and complex question, and I'll give you my personal opinion and what I think some of the facts show. First off, well, on average right now, states have an assumed rate of return of 7.4% on their investment portfolios. The best number that we can come up with based on our own ground-up analysis, looking at economic forecasts going forward, and referencing what other reputable organizations like Wilshire Consulting, for example, they know more than anybody about public pension funds, is probably something closer to 6.4%. And I should really emphasize, actually, that's what the experts are showing. And the bottom-up analysis we did as non-investment experts but knowledgeable people comes up with about that same number. Nobody has a crystal ball and knows for perfect, but that 1 percentage point gap is probably a good indication of what investment experts think plans are overshooting about. What's also interesting is if you dig into it, almost that full difference can be accounted for in differences between inflation assumptions that economists and investment experts use, which typically rely on the CBO long-term factor of 2%, and what the plans are using in their actuarial reports. So there's about a percentage point difference in terms of what's putting out there, but a lot of it can be explained as something as really being non-economic. The next thing I would say, though, is that all the actuarial projections and the assumed rate of return take a very long-term perspective, which is appropriate. And so I think it's understandable that those two things in terms of what the actual rate may be going forward and what people are pricing it at may take some time to kind of come together. So I think the short answer is I don't know that anyone's pants are on fire right now because of those differences. I would also say what the equity risk premium shows us is not something that's wrong. It's not a value statement. It's just saying the level of exposure that we have to the up and the downswings of the stock market. So in that regard, I think we would go to our good friend stress testing as a way to do the analysis, to show what the results might be at a lower rate of return in a manner that doesn't require a lengthy and protracted debate about actuarial assumptions, because I don't know that that's productive. I don't know the particulars of the article you mentioned in the second point, which I think had to do with whether states are looking at active management, and maybe in particular around private equity and some of the international approaches. I would say that international funds typically have done much more of their private equity and alternative investing in-house. Part of the reason they've been able to do that is they have a much more flexible compensation structure. In the States, the people who work for the public pension funds are fall somewhere in between from a compensation perspective, what a typical public worker would get and what somebody at Wall Street would get. So in other words, states aren't typically equipped to pay the high salaries that would be required to bring some of those sophisticated investment ideas in-house. So I would say that there has been some discussion that the Texas Teacher Retirement Fund, for example, has a very thoughtful and sophisticated model working closely with private equity partners, that the state of Massachusetts has one of the best alternative programs in the country, and has been bringing some real estate in-house. But for the most part, we would probably say that it would be difficult to assume that the states are equipped from a compensation perspective and an expertise perspective to do more in-house as opposed to less.
We heard earlier that there were three main risks to pension funds, and looking at the chart with New York at 98%, it looks like that the political funding risk was at least as big as the investment risk. What's your perspective on that?
I think that's a pretty fair statement. I think that we, looking historically, whether states have set aside enough money based on the assumptions or following their own policies, I think is the driver to understand the best. And so, yes, without exception. And then looking forward, I think the investment risk is a big part of the equation. When we do the stress test simulation model, we look at a set of simulations based on different economic scenarios and something we call the policymaker behavior framework. So in the investment scenarios, it just says, what if returns are 5%? What if we see a market crash according to the Dodd-Frank specifications? The policymaker behavior part is much more nuanced and a lot more interesting, actually. And what we essentially say is we'll make two assumptions. One is they follow the law to the T, whatever their policy is in place. And the other one says that they will, states will increase contributions, but they will not increase pension costs as a share of the budget. So basically you have an upper-lower bound of likely behavior. And then you can kind of peel back the onion on that. We have a really cool measure we call tolerance for payment. It was originally called tolerance for pain, but we didn't want it to come off as negative. So what the tolerance for payment looks at, to get to your point, is historically how much have states been willing to increase their pension contributions when there's been unfunded liabilities. I wish I had this slide for this because I think it's really interesting. But what you end up seeing, to answer your question, is a range of potential behavior. One that shows contributions growing significantly following the letter of the law of the state policy. Another one that's lower, which says, well, we're going to keep paying the same amount as 4% of the budget every single year with economic growth. And then there's a line in between that puts this tolerance for payment constraint on things. I guess the short answer to your question is yes.
Greg, I have a question regarding when you look at all the states that you've worked with and that you research. Is there a couple of models you've seen where people with a sense of comedy and goodwill are able to look at this coming from different sides of the table and be successful? I don't know if it's commissions but what are some really successful policies of getting to differing results that maybe are better long term?
Right. That's a great question. I'm going to buy myself some time by also pointing out a couple states that have just done well no matter what on managing their public sector systems. The state of Wisconsin stands out. They have a traditional defined benefit model, but have a very strong policy on making contributions that they stick to, and also have built in some of these cost-sharing features. When we did this 10-state stress test analysis, we found that Wisconsin didn't trip any fiscal metric under any scenario we looked at because they'd really accounted for everything. And so I just wanted to conflate my answer to your question a little bit to pause on that one. Probably North Carolina and Tennessee are two other states that have sort of been most successful in implementing good reforms. I would say that there really is no single exact effective way to have this dialogue. It really is kind of a no one-size-fits-all approach. Tennessee, I think, has one of the best designed, most innovative models, and it was a case where the state treasurer, working in some general coordination with legislators, just made it happen. They got really good advice. They thought about the issue really carefully. They did the right analysis and kind of just made it so in a relatively short legislative time frame. One of the states we're working in today, in South Carolina, just happens to follow a form where Republicans and Democrats from different sides of the aisle know they disagree on things, but when it comes time to do something important, they have a standard rhythm where they put a commission together that actually does real work. I don't know Vermont as well, but I think you also know that sometimes commissions are where policy ideas go to die. So I really think it really depends from state to state and place to place, and that there's a way to be as transparent as you can be as soon as possible. Yes.
Greg, could you come back to the longevity risk for a moment? With the investment risk, it's pretty easy to measure the difference between the assumption and the actual return,
Yep.
and that's creating the unfunded liability. But how are we measuring the longevity risk if pension funds are still assuming a life expectancy of X, and we know today that that life expectancy is much bigger?
Yep.
Is that not being reflected, and therefore the unfunded liability is actually not a lot larger?
Yeah, that's a great question. Before I answer that, are there any actuaries in the room? Just to make sure. Okay, I feel more comfortable then. So, if you were to say there's the two biggest concerns you have on the numbers, you would probably speak to investment risk and the mortality piece. And then I think policymaker behavior is sort of the overlay level of concern. We focus our analysis on investment piece for exactly the reason you said, which is something you can do with a reasonable degree of comfort that you're kind of capturing the right issues, with an understanding that longevity is also a big question mark. So to be totally open with you, I think we made a decision in our stress test simulations to focus on one issue because we thought it's something that you could put numbers around. And by itself, it's really, really important and potentially problematic. I think that the headlines on longevity risk are over time, actuaries and therefore state reporting on pension liabilities continues to reflect an extension of life expectancy. And we see this in the numbers where periodically the actuaries will pass a new standard of practice for this and the liability figures will bump up a little bit. The most recent version of that I think states began implementing on average about 5 years ago incorporates an idea called generational mortality. And what this does is not only take the latest and greatest figures about life expectancy and use that for the forecast going forward, but essentially makes assumptions about what life expectancy is expected to do going forward. So they're accounting for the fact that there will be continued improvements in how long people are expected to live. So I would point that out to say that by no means makes that a non-issue, but from my best understanding is that the actuarial practices have gotten better and stronger over time. I also understand that among the community there are a couple different points of view on the issue. One is that this idea of continuing extensions in life expectancy is something people need to keep forecasting. There's another idea that there will be some slowing down of that assumption. It's a really important topic, and I think we haven't focused on it at a rigorous way in our analysis yet, only because we think this investment piece is right in front of us and needs the most attention.
I could. I'm Beth Pierce, the State Treasurer, and I'm going to do my own presentation, so I'm not going to get into opinions. I'm just going to state a couple of facts. We do have mortality built in with improvement scales into our system. We recently went to what's called the RP 2014 modified, which is a new scale with generational, and you're going to see some uptick in our numbers based on that. So we do build that in. We have built that in. Private sectors actually had a different situation. They did not have a change. They had RP 2000 and then 2014. Yep. So private sectors actually got hit with bigger problems in terms of mortality because they hadn't updated those scales in a very long time. On the pension side and the investments, I'll talk more, and I would hope to get a question about that later, folks. But the bottom line is that when we come up with that rate of return, it's done by two different groups. NEPC, which is a pension, like Wilshire and some of the other groups, they do a model taking our asset allocation and a long-term capital assessment, do their own. They came up with 7.6. We also had our actuary, which is Segal, do it, and they put it into their own assumption base and asset allocation, put it into a capital model. They came up with 7.5, and we took the lower one in a consensus model. We did not pick the number. While the boards have to approve what the actuaries done, we've never turned around and said, we don't like that one, it should be higher. We don't do that. We've taken the models that professional, independent actuaries and CFAs have put together for us. So I just wanted to make clarification on that. And one other clarification, the numbers that you have, we changed over to net reporting our investments 2 years ago. Okay. So I think I would agree with you, that's a better way of going. I want to compliment our chair of the VPIC, who's made a lot of changes over the last 2 years, Tom Galanko over there, but we do now report the numbers as of net. Thank you.
Great. Can I just comment on that for a second? Or can I respond? Yes. I thank you, Madam Treasurer, for bringing that up. And I think, so the point was made is that the state has adopted the most up-to-date mortality assumptions. So that's a good thing. You also mentioned the state has moved to what's called net of fees reporting that shows results after the deduction of investment fees. So that's another one of our transparency recommendations, which is a positive. And I think I don't dispute the credibility of the organization. I know both of the organizations very well, as we talked about earlier, and NEPC is extremely reputable, as is Segal in that regard. Pardon me? Yes. So I think that all of those points are valid. And I just think on the investment return issues, it's a question of, another way to look at it would be, is there a lower rate of return to think about just so that we're better protected from the downside? And so that the state isn't targeting the 50th percentile with a flip of a coin going either way, but something that you might feel more comfortable is more certain to occur. I guess maybe that's a way to calibrate it.
I assume you've been into the weeds on the hybrid system. I noticed on your map only 4 systems seem to have adopted it. Do you have information on how many systems have looked at it and rejected it? Is any of that rejection based on an immediate budgetary imposition of more costs due to having to run side-by-side expensive systems for the long term? And this is sort of get away from the actuary things, which give me a headache.
Yeah, okay, so the question is whether the states that have implemented hybrid plans have taken into account that they're adding a defined contribution component, which has cost to it.
And I guess my specific is, do they get away from increased budgetary cost by seriously altering benefits for members?
Over the long term.
Or immediately?
Yeah, well, I think in the immediate, I would say no. In most cases, it's not going to have a substantial impact either way. That typically the results of those changes to benefit design end up with the state contributing benefits for new and current workers at about the same level they were before. The administrative costs are really important, but they are inconsequential in the grand scheme of things. The way, it isn't going to change the cost trajectory if the state is going to achieve a 7.5% rate of return. If, however, the rate of return is only 6% or 5% or something like that, and I think thinking about things in terms of the downside, when dollars for education and transportation are what are at risk, that's the analysis that demonstrates how taxpayers can be better protected. So in the case of Pennsylvania, I think, and in Pennsylvania, we found that over a 30-year time horizon, the state's fiscal position would be improved by $16 billion, about 10 percentage points on the funded ratio, if returns were only 5%. That's a stress test analysis that doesn't tell you what the answer is going to be, but gives you an indicator of just how much, what the different outcomes may be. The flip side is that does mean slightly lower benefits for workers on the defined contribution side, but we still found that they were getting to full replacement income. I'm sorry, does that get closer to answering the question, or?
Well, short term too, and other point was how many have examined it and rejected it?
Examined it and rejected it. So quickly going through the states that have done that. Connecticut did this most recently. Pennsylvania was the state that did it before that. The traditional hybrid model has been in place for years in Washington State, Tennessee, Georgia, Indiana, and at least one other jurisdiction. States that have considered it and rejected it. I don't know. I would have to think about that. Andrea, can you think off the top of your head about a location that gave strong consideration to this idea and put it off? I don't know. I would say that most every plan that made changes there to defined benefit plan probably had a conversation somewhere along the way about what things might look like if they adopted a hybrid. So, you know, by that observation, most states have decided that's not the path that they want to go down. But what we're seeing is, you know, now that we're 8 years past the onset of the Great Recession, not in the thick of it, states have more time to think about these issues a little bit more carefully, and so there's a little bit of an uptick in some of those changes. But I can't think of an example where somebody did a thorough analysis, had something on the table, considered it, and just decided it wasn't right for them at a very detailed level. But I think by the fact that most states have preserved their DB plans mostly as they are says that they've chosen not to adopt that route.
Nothing else? Okay, great.
Oh, let's look at that question right there.
Oh, excuse me.
So I'm not an actuary, but if a state is going to save $16 billion in the long run, who's going to pay for that? Seems to me that cost is going to be picked up by the employees not getting benefits that they would under a DB plan. And I also doubt that an individual's investment strategy is going to be as productive as a state's investment strategy. Are my considerations off base?
No, I think your considerations are spot on. Your considerations are spot on. So to give an example of analysis that we did in the state of Pennsylvania, What we did start with was measuring what retirement security for public workers would be under the new model. And we measure that specifically as replacement income as a percentage of take-home pay. Those are terms of art that just say, is the amount of money you're going to have to spend going to be close to or the same as what you had in retirement after you take into account that you're no longer paying certain taxes or contributing to Social Security and so forth. We found in the hybrid model that became the default in Pennsylvania that most public workers would be pretty close to 100% replacement income after tax, even in a scenario where, for example, the defined contribution component only generated 5% returns. So I think that's a way of answering the question, to acknowledge that a starting point should be what is the impact going to be on workers. The second thing I would say, and I think you drew out, is whether it's a good idea, generally speaking, to have individuals make their own investment decisions in a defined contribution type model. I think my sentiments are completely aligned with yours, which is most people aren't set up to do that. So if you go back to the, let me find this here. You go back to core principles. On the retirement security side, what we say is invest assets in professionally managed pooled investments with low fees and appropriate asset allocations. So in this case, in the context of the component of a hybrid plan that would be in a 401k style piece, professionally managed can mean the use of target date funds, funds that investment experts put together with a mix of stocks and bonds that reflect where each person is in their career and what their risk profile is. Long story short, it's a way to take the investment decision making out of individuals' hands and let them establish their goals and have the target date fund do the work. The federal government's thrift savings plan, I think, has been doing this for years and years. Pooled investments means essentially the same thing, which is by having experts invest everybody's money in a limited number of funds, you're going to keep fees low, which gets to the low fee piece, where we think there's two investments that belong in that kind of model. One are the target date funds that address this issue about professional expertise, and the second are index funds. And again, the thrift savings plan is a perfect example. They have 5 target date funds and 5 low fee index funds. The cost would be equal to or less than the cost of the pension system from that perspective. The target date funds take the investment decision making and put it in the hands of experts. And for those who want to make some decisions on their own, the low fee index funds keep the cost low. And so from that perspective, I think we would argue that that model with the appropriate asset allocation probably would have the same expected rate of return as the pension fund over time. The point that you started with is if investment returns end up in being lower than expected, maybe closer to the 5% across the board instead of 7%, you're absolutely right that that means individuals' balances when they retire is going to be lower than it would have otherwise, and they will get less in retirement income than they would from a DB plan. But I think that this, if you think about this as a balancing act, you have something that achieves full replacement income and also protects taxpayers against unplanned costs. And so I think those are the kind of considerations that people should look at. But I think all your sentiments are spot on.
Greg, with regard to stress testing and the legislation or maybe it's policies that other states have implemented, what specifically, can you give us a couple of concrete examples? Was it laws that were passed, the reports created, who creates the report, who gets the report? What exactly is going on with regard to stress testing in a few states?
So I think, and we can, I wish I had this legislation, and we'd be delighted to share with the treasurer and others, but 2 recent examples are Virginia and Hawaii. What the legislation in Virginia requires is that the plan, right, in consultation with the actuary, produce a set of reports that forecasts out pension costs and liabilities under 2 or 3 predefined conditions. And in particular, the requirements are results if the rate of return is 2 percentage points below the expected rate. In Virginia, that's 7% expected, a 5% downside, as well as an asset shock scenario that considers a big drop in the stock market like we saw at the onset of the Great Recession. And then it turns the duties and responsibilities and lists out the factors that are to be produced and leaves it to the actuary in the plan to figure out. So I would say that's an example where the plan is responsible for it, the role of the actuary is clear, that the guidelines of what those reports should show are also fairly specific, but it stops short of being prescriptive and sort of it's 2 paragraphs rather than 2 pages, if that makes sense. In the case of Hawaii, it's consistent in that the plan and the actuary have the same requirements to produce similar results. The only difference is that it is much more detailed and prescriptive as to the assumptions that should be used in those downside scenarios. So for example, in the quote-unquote asset shock, that's a big drop in the stock market, you might clearly define the Dodd-Frank adverse scenario as required by state law for banks to test as your benchmark for setting those assumptions. So I think in both cases it's expected that the plan would do that, and I think it can be the actuary or it could be somebody else. And then it just becomes a matter of how each state feels about in terms of how prescriptive they want to be in sort of giving direction.
And just, I think, his other point, is there any specificity as to who that reporting is shared with, how broadly it's shared?
I think that, I'm trying to remember the specific, I think the expectation is that it would be produced at the plan level and shared in the same way that standard financial reporting is shared. So I don't recall the exact specifics about the reporting requirements. I think there's a pretty clear expectation and maybe some specific language that this would be included with the annual reports that the actuary produces and the plan produces. And I don't know that there's been any pushback or concern about it being something that shouldn't be shared in that way.
When you were talking about target date funds as being a relatively secure place for people when they have to invest on their own, in the first conference I was at after the 2008 meltdown, over dinner I happened to be at a table with an executive from a company that does both institutional and retail investing. And I pointed out that their 2010 target date fund was down close to 40%. And I said that didn't seem to be offering a great deal of protection. And he said, look, we're much more heavily weighted in equities than that. If we actually gave downside protection for this kind of an adjustment, year in and year out, we would be so much below our competitors that we wouldn't exist now. Mm-hmm. So I'm not all that convinced that individual investors on their own can protect themselves in the way that you think they can.
Oh, no, I think that's absolutely fair. I think the problem the target date fund, as an example, solves is that it prevents individuals from making the typical mistakes that we see in 401k plans all the time. Putting money into funds with fees that are too high, without any sort of commensurate benefit from that, and allocating assets in a way that really can't be explained. So not having the right mix of stocks and bonds. It can't protect you from the up and down swings of the markets. I would agree with that wholeheartedly. But it also, maybe a simpler way to think about this would just be to think about a 60-40 portfolio. What if the plan was set up in such a way that defaulted individuals, just as an example, into something that's 60% stocks and 40% bonds? Madam Treasurer, I think you all do points of comparison on the pension fund against similar portfolios. So this is the 60-40 idea is something that people look at as a benchmark. And then the state of Oklahoma state plan for public workers takes a similar approach. They actually feel like, well, target date funds are great, but maybe too complicated. We're just going to put people in a 60-40 low fee fund, and that's it. So those are just examples of ways to solve the problems of poor decision-making on by individuals, and high fees that really don't pay for themselves. But none of those things can protect somebody from market risk or the upside of the market as well. That's a fair statement.
You mentioned, I think in your last or second to last slide, unanticipated cost to taxpayers. I think it was the phrase you used. Is not putting in what the actuaries require, the ARC, an unanticipated cost?
Yes, not paying the actuary required amount will, from our perspective, would generate unanticipated costs over time. Right? The cost of the pension system is dependent upon the accuracy of the assumptions and policymaker behavior following through on their part of the job to keep the system affordable and sustainable. And if there's falling short on that, as we all know, that ends up costing more over time. because of the lost investment earnings that those funds would otherwise have generated. So yes, I think that would be a fair characterization. We'd agree with that.
Quick question, and I guess I don't know how to think about this, and I wonder how you think about this. We tend to think very binarily, retiree, taxpayer. When it plays out when there's not enough retirement assets, what's the data on how much comes back to taxpayers ultimately? Is there any data? In other words, with insufficient, I guess you call it insufficient safety net, or with insufficient retirement assets, how much ultimately then goes back to the taxpayer versus, say, charitable organizations, family? I don't know if there's any data, but I never know how to quantify this, or if indeed this fits into a useful way to think about it.
Right. I think the question you're asking, and please tell me if I'm wrong, is if we were to do something, if Vermont was to do something different than it's doing today in the benefits it provides to public workers, and those benefits were not as good as they've been historically, is there some unforeseen cost to the state if those people end up, being in a poverty kind of situation? If that's the right question that you're asking, and I think it's a totally fair question. I would say that concern is something that the 7 states that don't provide Social Security for their public workers should be absolutely concerned about. In the state of Colorado, for example, as we've talked about before, they have done a really good job of assessing fiscal health. The state has an unusual provision that constrains their ability to increase budgetary spending across the board. And it's also true that the public workers do not participate in Social Security. So you have a system that's really at risk, and then you have hundreds of thousands of public workers who depend on retirement income completely from that pension system and are not participating in Social Security. I can't quantify for you sort of exactly what that could mean, but I think that's the place where it's applicable. The good news is it's very limited. It's 25% of public workers overall, 25% of teachers. It is 40% of public workers all. A lot of the municipal, police, and fire are another example. So I think that would be the area to sort of give that issue some attention. But in Vermont, the participation in Social Security prevents that. And I would say if you start with that foundation, and we would estimate that for the typical public worker, Social Security, taking account for inflation, would provide 35 to 40% replacement income. I think you get to a safe place under a number of different approaches pretty quickly from there. In other words, if the replacement income after tax for a public worker is 70 or 80% versus 100%, I'm not saying any of those numbers are correct. I think all of those outcomes are in a range where I would be hard-pressed to understand why that's forecasting unplanned costs in terms of people going into poverty. So the short answer is for states that don't, or plans where Social Security is not part of it, I think that's a consideration. And in other instances, I don't think there's really data to prove that that's part of the equation looking forward.
In your discussion of OPEB, you suggested that we take a look at the relationship between the plan's healthcare benefits and the federal government. Could you expand on that?
Yeah, I'll expand on that if I can also just be really careful. Currently, the state provides a pretty significant benefit for public workers in the form of retiree health care. If we think about the developments at the national level and providing affordable health care for all, and if we think about Vermont as being one of the states that probably has one of the most sophisticated perspectives on that in the country, Massachusetts, my home state, is obviously another one because of where we started 10 years ago. It stands to reason that a conversation about both those things at the same time could make sense. What I don't want to suggest is that we have any really specific recommendation, because we've talked to other states and it's proven to be a really difficult conversation. But it could be the case that there are lower income workers who would do just as well under the national program. And if that's a way to have lower costs for the state through the benefit of federal subsidies, maybe that's something to think about. I realize I'm the one that brought this up, but I want to be really cautious about this because this is the perfect example of, Vermont needs to come up with its own solutions. But what I will say, in a number of states we've had this conversation come up. The focus of it has been whether lower income workers could do just as well under the federal program at a lower cost to the state, and then it inevitably becomes so complicated it's hard to move it forward. So I was hoping the people of Vermont could kind of educate us about whether that's something to analyze. So
So what time frame does Pew recommend, or are you seeing nationwide as far as repairing the funded status of pensions, given the fact that the government will allow a 30-year plan to be enacted by state and municipal governments, and some governments choose to redo their plan every 1, 2, 3, 4, 5 years and get a fresh 30 years. We aren't doing that, but I would like to know what is the nationally, and what is your recommendation as far as length of time to repair the pensions, please?
Okay. So I think that question is asking what is the right time horizon or target date for the state and the actuaries to calculate these payments towards the unfunded liability round. And just by way of background, you referenced a really important point, which is that the accounting standards in the states allow for a 30-year time horizon with some level of flexibility. And I think what has happened over time in many places is that people have taken that 30-year time horizon for paying down the unfunded liability, which is an accounting boundary from under GASB, and used that to inform policy. And lo and behold, the math says if you come up with a 30-year mortgage payment plan, you actually lose ground, you don't make it up. So the short answer, I think, is that most of the experts are now pointing towards a 20-year time horizon as one that is sufficient to expect to make progress year over year on getting to fully funded status, and provides a little bit of cushion in the face of a downturn. And I think Vermont is pretty much there. I don't know if you would tell me differently, and so I think that that's good news. There are some nuanced technical terms. Layered amortization says if you have a loss, it's okay to come up with a plan to pay for that loss over its own 20-year time horizon, but just don't go beyond it. And I think what's interesting is that the Moody's Treading Water benchmark, the net amortization metric that we publish every year around, a recent report from one of the actuarial bodies that looked at this idea of what's the right answer to make progress on paying down your unfunded liability, kind of come back to the 20-year number or something less than that as being the right answer. So I think that's sort of the way the thinking in the field has emerged.
Greg, can I just pick up on your middle point about investing in professionally managed pooled investments? You mentioned Social Security, and it has its place, but many people have said Social Security is a massive hit on younger people. I mean, there are workers and there are workers. And if you look at Social Security's returns relative to someone who started off young and was putting it in a professionally managed pooled investment, there could be quite a gap. So isn't there also a generational impact in terms of defined benefit plans that are overinvested in fixed income? And are any states examining the differential risk aversion, risk preference of workers, and recognizing that younger workers might have a different perspective on retirement contributions than older workers?
Well, in the case of Social Security, the way the money in effect is invested is at a risk-free rate. And I think it's generally understood that the younger you are, the more you're paying for whatever benefit you're getting from Social Security. We would not be part of starting a conversation to do away with Social Security, so we take that as an important given and a foundation for retirement savings, as imperfect as it may be. The question you're asking is a really interesting one, if I'm understanding it correctly, and also a pretty sophisticated one, which is whether, I think if I have this right, have states examined whether the investment strategies they're following for their pension funds are aligned with the younger workers that are now entering the workforce and how they would choose to invest that money?
Correct. I mean, it's difficult. It's an abstraction in Vermont. We have about 6 young people, but if you go to other states, I mean, that's perhaps why you felt so youthful as soon as you drove into the state. States that really have young people, yeah. I work with young people, and someone who's in their early 20s and you discuss retirement, their perspectives on what they're going to invest and what they expect are radically different from someone closer to retirement. This room, or even this state, is perhaps not a good representation of that.
The short answer is no. I don't think anybody has. It's a really good and sophisticated question. I don't think anybody's been able to crack that nut. I think that while we're coming to understand that millennials are more sophisticated in a number of different ways, including in certain respects understanding why index funds and ETFs are better than trying to gamble on the stock market, making their own decisions. All the research we shows demonstrates that people in their 20s understand retirement's important, but really aren't thinking about it as much as they do progressively in their 30s and 40s. I don't think the internet has not changed human behavior in terms of how we look forward on these kind of issues.
So market timing takes on all kinds of faces. In the governor's presentation this morning, he mentioned essentially that we have population problems. Have you done any correlation with flight from states like Vermont that taxes benefits and has relatively low benefit structure, and individuals leaving to head for other places? I think in one of our plans, fully 25% of our benefits go to other zip codes, and that probably is not a great thing for our economy.
That's a good question. I think, no, I think that looking at whether... Oh, I can.
Do they do any tracking on where people go when they don't have adequate income, and whether there's flight characteristics based upon people leaving for lower tax situations or things like that, and how that impacts local economies, since a dollar spent outside the state is no benefit to the state at all?
Right. No, I think on that sort of thing is just outside the scope of our project. I think one of this is somewhat related, but one of the issues that there's been more attention to is whether the budget challenges that depend a lot on pensions in states like New Jersey are starting to have some of these migration impacts that previously have been kind of a point of contention among economists. But I understand that's a slightly different question than you were asking.
All right, unless there's one last burning question, let us thank Greg for his presentation and questions, and then we'll take a break before we go into our panels.
Thank you.
Thank you. We're going to start up again. This is now, we're going to go to our last segment of the day for this conference. When this segment is complete, we're going to have lunch served. And we hope that all of you are willing to stay and join us for this complimentary lunch and give you an opportunity to continue the conversations that I just had to end. We're going to have two presentations. We're calling them panel presentations, each lasting 30 minutes approximately. You know, I'm going to try to be a timekeeper. I have little laminated cards that I'll hold up to let people know what time they have remaining. We'll do our best to stay on schedule. You know, the only thing standing between you and lunch are these panels and a question and answer period. Once both panels are completed, we're hoping that the audience has approximately 30 minutes to ask their questions. If you want to ask a question from the audience, if you can raise your hand like we did earlier, we'll walk around with microphones. If there are questions, if you don't feel comfortable, because not everyone does, asking a question publicly, if you prefer to do it on a more private basis through index cards. There are index cards at your table. If you hold them up, we'll walk around and pick them up. I'll do my best to alternate if we have written questions between written questions and the questions coming from the audience. So we have two different panels. The first panel, and I'm going to introduce everyone now just so we can make things flow better. The first panel is, I guess, we kind of called it internally Making the Case for Action. The presenters are David Coates, the former managing partner of KPMG's Burlington office, and Mark Crow, the president of 10th Crow Creative, an advertising and design agency in Burlington. The second panel is entitled Vermont's Policy Options from Policymakers, and the presenters are the Vermont State Treasurer, Beth Pierce, and Bill E. Childers, the Executive Director of the National Public Pension Coalition, where she leads national and state efforts to protect the retirement security of public employees and advance retirement security for working Americans. And we greatly appreciate her coming all the way from DC. Thank you for the travel, which I know yesterday wasn't a great travel day. In the next few weeks, the Vermont Business Roundtable will be sending you an electronic survey on this topic to gather your feedback. That will be taken in from the Vermont Business Roundtable, and we'll circulate the overall results of those surveys back to this group electronically. So we would ask you to participate in that survey when it comes up. And with that, I'm turning it over to David Coates.
Okay, I think it's still afternoon, so, no, morning, excuse me, good morning. It's great to see such a group. We've lost a few, I know, because of the timing, I guess, but Greg did a great job explaining what's happening at the national level, and Mark and I are going to explain a little bit what's happening at the Vermont level and sort of make the case, and then we'll hear from Beth from the other side of that aspect. But again, as they said, it's a complex issue when you start talking about OPEB, retiree health care benefits, and pensions, and you've got a little bit of that flavor from Greg. But these are huge obligations that our state of Vermont is facing, obligations that right now are critical to our whole financial structure. And we're gonna present the case that these are getting higher and larger going out into the future than they are right now, and they're already a problem. And I would say also that we've really, and I've said this in a couple of editorials, we've been kicking this can down the road, and really, I don't think there's any road left. And I think what's the other side of that road is really a cliff, and we can't afford to go over that cliff. But before we begin, I do want to say a couple of things about our treasurer. I think it's important for everybody in this room to understand that without her work over the last 8 years, that we would be in much dire straits than we are right now. She has saved this state millions and millions and millions of dollars with regard to the pensions and the retiree health care benefits. And I can only... Our unfunded liabilities would be much higher than they would otherwise be. So Beth, thank you again. And with that, I'm going to ask Mark to come up and start our presentation.
I'll just leave this up the rest of the time. So yeah, I'm Mark Crow. I'm a member of the Vermont Business Roundtable, as well as president of 10th Crow Creative, a branding and marketing agency here in Burlington. We're here to shine a light on an important issue. Important because if you think about it, it really affects all Vermonters. Yes, there's a potential impact to the participants in these plans, but it also potentially affects every Vermont taxpayer, and for that matter, every person who benefits in some fashion from state, local, and municipal spending. But as David just said, it's a complex issue too. Not one that is readily understandable, as you maybe have learned a little bit from earlier today. There are big numbers, a bunch of data used to come up with projections and discount rates and assumptions, and a host of other things. And to be honest, they're all governed by an accounting standards that I don't pretend to understand. And let's face it, which was also alluded to earlier, unless it's your job, I start to glaze over pretty quickly when we start talking about this stuff. So my portion of the presentation is to kind of give a high-level look at the issue we are facing. And then David will dive in deeper into the details. So what are we talking about? Well, as you may have already gathered, we're talking about the Vermont State Employees Retirement System and the Vermont State Teachers Retirement System. But specifically, we're talking about the state's obligation to fund or contribute to the pension and retiree health care plans under these systems. What is the obligation? So right now, the state is obligated to fund, as I said, retirement and retiree health care contributions to about 32,000 teachers and state workers. What's the problem? Well, so far, the state has only been making the minimum required payments to the pension plan. Minimum required payments is my layperson's term for what you've heard earlier as the ARC, the annual required contribution. The state has not been making any payments to fund the retiree health care plan. The result is we've got $3.6 billion of unfunded liability to these plans. It breaks down evenly. It's about $1.8 billion of unfunded liabilities to the pension and about $1.8 unfunded liabilities to the health care plan. As you can see, that breaks down to about $15,000 per Vermont household. On top of that, under the current 20-year amortization schedule, that minimum required payment, or the ARC, which was $112 million most recently, is projected to increase, is projected to increase to $313 million before the obligations are paid. Now, that's a lot of numbers. What does that really mean for us? Some not so great stuff. First of all, there's a significant threat to our bond rating. June 30th, 2018, the state is going to have to start reporting the unfunded retiree health care liability of $1.8 billion. It's been reporting the unfunded liability for the pension, but not the health care. That has to be reported starting June 30th, 2018. What's the result of that? Well, that's going to end up affecting our net worth. Our net worth is going to take a hit. David will get into it a little bit more later, but it could result in a nominal or maybe even negative value. And what does that mean? Well, that's going to give some heartburn to these rating agencies and could result in a lower bond rating for us. Why do we care about that? Well, as probably most of you know, it's because if that bond rating goes down, financing costs are going to increase by the millions and millions of dollars for all state, municipal, and state-related entities such as VSAC. The other thing is that ARC payment that's going to keep going up. If for some reason we can't continue to pay it, that's also going to give those rating agencies heartburn and could also lower our bond rating. The other thing is, again, as that ARC increases, where's that money going to come from? It's going to have to come from the general fund or some other place to fund these ARC payments, which obviously means there's going to be less funds available for important state programs and initiatives. And then also, it's just simply an unsustainable burden for the taxpayers that will continue to rise. You know, to put a little, I think, and this fact I think came up earlier, to put it in a little context, the debt to cover state and municipal bonds for the general obligations, the nuts and bolts stuff, the infrastructure stuff, is a bit over $600 million. We're looking at $3.6 billion. Where's that going to come from? Right now, it's basically two sources: taxpayers or investment returns, which David's going to get to in more detail later. So to recap, we've got $3.6 billion of unfunded liability. We got an ARC payment that's going to increase over $200 million during the course of this amortization schedule, up to $313 million. That's the projection. And those things working together threaten our bond ratings, will continue to drain our general fund, and ultimately create a situation that at least seems unsustainable and unaffordable. So that's the high-level overview. Hopefully it was somewhat useful to those of you who needed it, like I know I did when I first started learning about this stuff. But really, the bottom line here is that we can't continue to shut our eyes to this issue and hope we grow our way out of it. I think we've seen evidence that that's not a real likelihood either this morning. I know we as a state, arguably, have many other pressing matters to deal with, arguably some of them much more immediate than maybe this one. But if we truly want to make Vermont affordable, we really need to take the necessary steps now to address it and not wait till later. Okay, that's my bid. Now I'm going to hand it over to David, who's going to shower you with more insight and detail. Thank you.
Okay, now we're going to delve into some of the aspects of what Mark just went over and give you a little bit better perspective. First of all, we're going to talk about the current status just briefly. And as you can see on this slide, the important part is on the right-hand side, 63016, actually the left-hand side, right-hand for you. And coming down that column, you'll see $5.2 billion total liability. That's the amount is estimated as of June 30, 16. And remember, we're basically working with June 30, 16 numbers. The current report will be out, I think, in November, but we're dealing with 6/30/16, so we're a year old on that. So that's the amount, the present value of the amount that we would owe at this particular time for the participants in our plans. And again, it's state teachers and state workers. And the next item, $3.4 billion, is important. Take a look at the asterisk over there. You'll see that when you look at the fair market value of those assets, the investments as of June 30, 16, they're really $200 million less than what's reported. And that goes back because in an actuarial aspect, they do what they call the smoothing technique, which they take the gains and losses and run those over a 5-year period. So if we were to have shut down everything at that particular time, June 30, 16, we would have had a $2 billion unfunded liability. Again, that's a moving target. And going down below, you'll see that we have the OPEB, which we've been talking about, at a $1.8 billion, which just happens to be the same as the unfunded liability for the pension because of rounding. But in total, the significant amount, is $3.6 billion. And that represents about 2.5 times our general fund revenues and about 6 times our general obligation bonds. And as Mark had showed on his, it's about $15,000 per household. Now, this next one represents history. From 2008 to 2016, this is how the ARC has risen since 2008 to 2016, It started out when I began on this journey, I guess you would call it, at $800 million, and that was 8 years ago. Now when we look at it, it's at $1.8 billion. It's gone up about every year, and that's going to be a concern just looking at that. However, we've been able to fund that ARC that's been required. So now what are the issues, the specific issues and the specific problems? And first of all, as we look at the pension piece of it, I believe the liability is understated. To what amount, I'm not sure at this point, but Moody's took a look at our rate of return a couple of years ago and said that if you're using 5.67, not far off from what Greg was talking about with Wilshire at 6.4, as I recall, that we would have added $1 billion more to the state's unfunded liability just for pensions. And as we know, as of June 30, 17, Beth and the group did reduce the rate of return from 7.95 down to 7.50. And based on my discussions with Beth, which are very informal at this time because we don't have the actuarial report, that would create about another $150 million of unfunded liability. And as Mark related to the GASB, the General Accounting Standards Board, it's the Statement 67, that requires the actuary in their report to show what it would be if the rate of return was 1% more or 1% less. And if it were 1% less, it would be $600 million for both of the pensions, okay? And this was only $150 million, and it was not quite a 0.5%, which would have been about $300 million because of other assumptions that were made and changed during that period of time. Now, look over to the right, and you'll see the actual rate of return, and I use just the state workers' pension results because the teachers are pretty much the same. And you have the 3, 5, and 10-year return on that. And what I didn't have room, the 1-year return was up almost 11%, And I think we all acknowledge that the market's been on a roll, so that's reflected there. And just the other day, I got from Cliffwater, LLC, which is the pension advisory group, and they looked at all state pensions over the last 10 years ending 2016. They don't have the 2017. And the average was 5.7%. And although you don't have it on here, ours was 4.64%. Coming back over to the last item on this left-hand column, this reflects the fact that we have reduced the rate of return by 45 basis points. In discussions with Beth, it looks like that will add $10 million more to the ARC, I guess starting in 2019. And then at the very last part of that, the black, you'll see that our low funding ratios is what we call them. You look at the state side of that, the state workers is about almost 75%, and the teachers, very low for many reasons I think Beth will describe, is at 58%, but on average, we're talking about 64%. Now, some of you may be asking, well, why is he comparing, why isn't he showing all of these separately throughout this? And the reason is because the state owes both of these things, and we have to look at them in their totality, not break them down individually. So that's why we're doing this. Now, I also talked about that being the unpredictability of the annual required payments. And what I'm going to show you and what you see on this slide is why I say unpredictability. And this is an actual case study from the Buck Consultants reports. In 2010, they projected the ARC to be $95 million in 2017, and that was based on a $1 billion unfunded liability. Looking at 2014, it's going to be $102 million is what they projected at that time. And then in 2016, it was projected at $118 million. And that's because our unfunded liability is going this way, so the ARC has to go that way as well. So I know we have several members of the Appropriations, Finance, and Ways and Means. I mean, these are things you need to take note of, in that if you're looking at these projections as being cast in stone, they're anything but being cast in stone. They're just moving all over the place. And then the recap is in the circle, which in 6 years, we're talking about adding $23 million to that ARC. And that's a roughly 24%. And I know some of you on the Appropriations Committee have said, well, where are we going to get the money? We're always looking for money for, this is one of the reasons that's creating that in our state. Now, this is an interesting one. Again, it shows this ARC payment starting at $27 million back in 2008, and over the 9 years, it goes up to $108 million, and this is history, okay? And the interesting part of it, and you heard Greg talk about what should it be as a percentage of revenues, that's how states make monetary decisions, and I suspect they should start making political decisions as well. When you look at 2008, that $27 million represented 2.25% of our general fund revenues. And you look at 2017, and it represents 8.1%. And it's kind of, the analogy I would say is kind of like the frog that's put in the kettle on the stove, and you start turning the heat up, and as you can see, the heat's been turned up. So is the frog well done, or how at this point? I think the next slide will tell you as we look at where we're going on this. And this is about using the actuarial numbers as well as the revenue numbers that are being projected. And we're looking at through 2037, which is the end of the amortization period. We have 20 years to go on that. And Greg mentioned we were on a 30-year amortization, as Beth has told us as well. And so what do you draw from that? Well, the 118 represents 8.1% of our general fund revenues. When you go to the 313 million, again, that would be the end of the payments. We wouldn't owe any more going forward. And that's keeping the promise that we made that we would do it in 30 years. Well, we already know it's going to be more than 1.8 because we're going to be going up $150 million this fiscal year. And I think I'll make the case shortly that we're going to be going up even more than that. So what we're saying during this period of time is that that puts pressure on the state's general fund revenues. It puts pressure on Ways and Means and Appropriation and Finance in the State House. And it also means that there's not going to be a market correction or a recession during that next 20-year period of time. That's not built into this. Okay, now I'll talk briefly about retiree health care benefits, because there's not a lot to say except that we're paying a lot of, or we owe a lot of money. We owe roughly $1.8 billion, and I don't know if it's going to be higher or lower this year coming up, but more likely than not it's going to be higher. We don't pre-fund it like we pre-fund the pensions, which we should in order to establish a sustainable fund so that the money will be there to pay the participants when they retire. Instead, we have an annual deficit in funding of over $50 million. And the ARC that would be required here in 2016 was $112 million. We paid only $58 million of that, so we left $54 million unresolved. And what we paid, we're on a pay-as-you-go system, which essentially means we pay the expenses of the fund and we pay the participants' costs as well. And the liability, based on the way I look at it anyway, is it will have to continue to grow as it's left unchecked currently. So there's no plan or strategy that I'm aware of. I think Beth will address that. And it's not like we're the only ones in this boat. Greg mentioned that other states had the same situation or similar situations, but I mean, who wants to be in a sinking boat? I think it's Vermont's best interest to get out of that boat before it sinks. The rating agency considerations, I think the governor hit on that, and it's there. You can go online and review the comments, but essentially they're saying that our benefit liabilities, particularly for AAA-rated states, are higher than they should be. We have weak demographic trends, and our state's economic growth potential is kind of dampened. Now, the impact on the state's financial statements, Mark alluded to that, and let me just add a little bit more to it. If you take a look at the CAFRA, which was as of June 30, 16, the net worth or the net position of the state of Vermont was $1.2 billion. Now, GASB is requiring now that we have been putting pensions on, and now we're going to have to fully put on the OPEB net liability. And as of June 30, 18, it will all be fully integrated. But this will likely result in a net worth, based on my numbers, to the state of Vermont, and based on the fact that we have another unfunded liability that will be increased. So, I mean, is this what we want for our state of Vermont? Is this a reflection on how we handle our finances? I don't think so. However, this is the fact that we're in this because we have to now record these liabilities that haven't been addressed in the past in an appropriate way. Now, as I wind this down, still think I'm within my 30 minutes. That's good. Let's talk about why action is required. And most of these things you've seen, and we have low funding ratios in the state of Vermont, 65%. If we were in the private sector, we better have 80%, or we're going to be written up all over the place. The increasing pressure on the general fund revenues. I went over that slide. You saw that slide. We're talking about 8% right now, the general fund revenues. We're talking about going up to 12% of the general fund revenues when we get over the 2037 mark. And thinking about, we started out in 2008 at only 2.25%. How can this happen? How can the state afford it? And that's the question, I think, that the money committees have to ask, as well as the administration. You really have to take note of where this trend is taking us. The rate of return is likely overstated. CalPERS is going to 7%, and you heard Greg talk about that. We also heard Greg talk about a low-risk profile for our investments, which gives us a lot more stability. We've taken a lot of the risk out of it. Well, when you do that, you're going to take out the return out of it as well. So that's why I'm saying even that 7.5% return, that's too high. If we were to reduce that to 7%, that would be another $300 million that we have to add to our unfunded liability. And if it were to get down to something like, I think Greg mentioned 6% or 6.5%, if it was 6%, that's basically another $1 billion that we would have to add to that. And that means that ARC goes up proportionately. So we aren't anywhere near out of this thing, understanding that we've underestimated or understated the liability that we owe the state of Vermont. So I would then say we have no plan to deal with the health care, and I won't talk any more about that because I think everyone knows. And then we would move on to what I consider our weak demographic trends, and I don't want to repeat everything you've heard, but some things need to be repeated. And the rating agencies have talked about it. We have a stagnant population. There's no growth going forward. We have many, many people on Medicaid. We have nearly 1/4 of our people get Social Security checks. We're the second oldest state. We now have 18% of our population that's over 65, and by 2030, there will be 37% of our population over 65. People are just living longer. We've heard that before. And they're getting up to 40 years after retirement. So when you take a look at a defined benefit plan, that whole 40 years has to be built into what we're talking about here for funding. And I don't think it's quite at that level yet. I know it's getting there. The state's economic growth potential. Well, without repeating what the governor talked about, we know, I just think in the last week, unemployment claims were at their lowest levels. I think they were like less than 300. Projected revenue growth through 2027 precisely is being estimated at something less than 3% compounded. And this is really the rub. The ARC is going up at a minimum of 5% per year. And our revenue growth is something either less or about 3% per year. So there's an imbalance. And you see that on that previous chart where it's going way out of bounds, and that's why it's 12%. The estimate's going to be 12% of our revenues in 2037. And of course, we know that our administration has said that the folks in state government better hold the budget line for 2019. So, looming on the horizon, we have the federal budget, we have tax reform, which I really want to make sure you understand. If we lose the federal and state tax deduction, that's going to mean a big, big hit for Vermonters who are paying that and deducting it on their federal, because when you deduct that on your federal, the federal tax dollars you're saving, you can equate that to the fact that high tax margin or high tax in the state of Vermont is lessened by the extent that you get those federal dollars back. And if we lose that, we're going to be in trouble. We have to clean up the lake, statewide property taxes going up 8%. So at the end of the day, the problem I have, is that all of the risk is with the state of Vermont and the taxpayers on this. We have to some way de-risk these plans. How we do it, I'm not sure, but I do think we can come up with a solution as long as we all understand the problem. And the other piece of this, it says all the risk is with the state, but if we don't come up with those problems, the risk will then fall on the participants. And you know what? That's the last thing we want in the state of Vermont. So let me just close by saying we've made promises to the state workers, to the teachers, and we want to keep those promises. But if we don't do something really darn quick, we aren't going to be able to do that. Thank you.
Just need 1 second. Sorry.
Let me just, I can't, so if you can, okay, then you can press play.
All right, you get to awkwardly look at my picture while I'm also talking. You can see that I have lightened my hair since that photo, so I should get a new one, I guess. Did it for summer, now it's fall, but I'm going to stick with it, I think. So thank you so much for having me today. My name is Bailey Childers. I'm the Executive Director of the National Public Pension Coalition. And we work to help ensure that Americans can retire with dignity, because we believe that after a lifetime of work, all Americans should be able to have access to a secure retirement. So I want to approach this conversation from a different viewpoint than has been expressed so far, and encourage us all to think about some different framing when we talk about retirement and pensions. And so what I mean by that is that we've got to have a discussion about the quality of life that we want for people when they retire. So what do we want men and women? They've worked their whole careers. What do we want retirement to look like for them here in Vermont? And in, I work in a lot of states, but since we're here, we'll just talk about Vermont. But what do we want that to look like for people? And, pension policy can't be done in a silo, because there are all these other economic issues that come into play when we talk about pensions. And part of the reason I say that, so NASRA, which does a lot of good work looking at pensions all across the country, the types of systems, they track all the kinds of changes that have been made to systems and a whole other variety of data, so I encourage you to look at NASRA's resources when you have a chance. But they also look at pensions as a percentage of total spending in a state. And in Vermont, in fiscal year 14, pension spending was 1.95% of total spending in the state of Vermont. So 1.95%, that's up slightly from 1.58% in 2004. But if that's the percentage of total spending, there are a lot of other things that we've got to be talking about when it comes to pensions. And so a couple of those questions that I'll throw out to you all as we start this discussion. So what is the level of retirement that you're wanting to be able to offer to workers? I was at a conference I guess it was maybe a month or two ago, and there was somebody there from Pennsylvania, and they said, the Pennsylvania teachers' retirement system started because people were, out somewhere in Pennsylvania and saw their retired teachers living on the streets. So they'd retired from a career of teaching and were living in poverty on the streets. And people said, that's actually not what I think should happen to the person who made such an impact on my career and my life by being my teacher. And that was how we got the Pennsylvania teachers' retirement system. And so looking back at why these systems were designed and what they're intended to do for people, I think is a really important piece of the conversation that we've always got to keep in mind. And then second, how do pensions fit in the overall budget picture? And that's also got to include tax policy. So is your revenue structure, what are your spending patterns? Does that really match up for what you need? Not just for pensions, but for education, infrastructure, the environment. I heard some about the algae in the lake at dinner last night. So, there are all other kinds of considerations on your spending and tax policy that you've got to take into account. Pensions are just one piece of that. And then a couple of other questions to just throw out there. What are the costs going to be for recruitment and retention of workers if you don't offer a quality retirement program? So in the state of Alaska, that on Greg's slide was mentioned, they changed to offer only a 401k option for their state employees and teachers. I want to say it was in 2001. Anyway, they are not a Social Security state, so now folks only get access to this 401k. It is costing the state of Alaska $20 million a year to recruit teachers. So that's a cost that I think you've also got to take into account when you're looking at a retirement plan. There are other costs than just the normal cost to provide those benefits to employees. And then finally, and this is a question that I think would be really interesting for research and one that hasn't been explored a lot, what are the costs to the state of not providing retirement security? So if people are retiring into poverty and need state services, they need income supports or housing supports, or probably help keeping the heat on. I assume, winter here gets pretty chilly. What is that cost going to be if people can't afford to retire and the state's got to take care of them in that way instead? And I would imagine that the pension is a lot better investment than putting people on state services, and one that I hope that we feel is better for people too, being able to afford retirement and their basic expenses. So with those kind of big picture questions, let me talk a little bit about why public pensions are a good thing, and why I think there was somebody who asked the question, have states considered these other models? They have, and for the most part, they have not moved to them, and there are a few reasons why that I want to talk about. So first, in the aggregate, public pension funds are in good financial health and improving. I know that may not seem true to you, but it is. NCPERS did a great report on this. They found that in the aggregate, pension funded status is up to 76% across the country. That's on a third year of improvement in a row. Post-recession, it's been difficult for systems, but they are starting to recover. So for the most part, pension systems are healthy. And there are a tremendous amount of assets under management in public pension systems in this country. Greg likes to talk about the unfunded liability, but the funded status of pensions, there are $4.1 trillion in assets under management by pension systems in this country. And that's a ton of economic investment that pension systems are making in local communities and in states all over this country. So I think it's important to keep that number in mind as well. There's a very healthy amount of money that systems are injecting into this country. And then states making their full annual required contribution is the most important way to keep a pension system in good shape. I think that's been talked about by the people before me, and I know Treasurer Pierce will talk about the history here in Vermont that I hope will enlighten you as to some of the reasons why we're even having this conversation. The other piece I'll say on that, however, is when the systems are fully funded, you've still got to make good, smart policy decisions about continuing to make those payments and not doing something like a retroactive benefit increase that you didn't pay for, which has gotten some states into trouble, like California and Illinois, for example. And then, the last thing I'll say on this, 84% of state and local public employees still have access to a pension. So, like I said, I think states have talked about this. As NASRA will tell you, almost every state has made some kind of tinkering or adjustment to their pension system since the recession, but they're sticking with pensions because they know they're better at providing retirement security for workers, and they're more cost-effective for the state, which I'm going to talk about as well. Another thing I want to mention is for states that are not in good funding shape, changing the benefit design does not help that. So those are two completely separate issues, and I think that's really important for you all to remember in whatever discussions you move forward with in Vermont. The unfunded liability has to be dealt with. Again, I go to a lot of conferences, so sorry if I'm going to tell you some stories that I've heard people say the last few months, but a few weeks ago, I was at another conference, and someone gave a great analogy. They said, you've got a credit card, you've racked up a lot of debt, you're like, oh, I'm kind of in trouble with this now, I got to deal with this. So you go open another credit card. Well, that doesn't get rid of the debt that you had on the first credit card. You've still got to pay for that. So that's how I think is a good example to look at pension systems. If you've got an unfunded liability, changing the benefit design for future workers has nothing to do with paying off your unfunded liability. And it's really important to keep that in mind. So the reason I want to now talk about pensions being more cost effective for the state, because I think that's another reason when states look at making changes, they don't go for it. And I want to talk about West Virginia as an example there. So West Virginia teachers, they'd been under a defined benefit plan, and then in 1979, the state began shorting its payments to the plan. By 1991, the state had decided, we can't deal with this unfunded liability anymore, and they closed the defined benefit for teachers and opened a defined contribution style plan instead. As I just mentioned, though, that does not help the unfunded liability. So what they found was that the unfunded liability of the teacher's closed pension plan continued to decline, and it dropped down to about 25%, partially because no new members were contributing to the plan, and that unfunded liability was still out there. So in 2003, the state decided to study it, and they found that the normal cost of providing a retirement benefit under the DB, under the teacher's retirement system, was half what it cost the state to provide a retirement benefit under a 401k. So they actually decided that they would go back to a defined benefit plan. So in 2005, they reopened the defined benefit plan for West Virginia teachers, and then by 2010, the funding status had increased to 58%, and they are expected to be fully funded by 2034. So West Virginia is a really important example. That is a state that has tried closing the plan. It did not work. They went back to it, and teachers now are able to get a better retirement as well, which is another important piece of the picture. Part of that, and there's a slide in the treasurer's presentation that I encourage you to look at. It's a pie chart, I think toward the end. So about 75% on average the cost of the pension system come from the employee contributions and the investment earnings. And actually in Vermont, that number is a little bit higher. Between the years of 1993 and 2014, 14% of the cost came from employee contributions and 63.8% came from investment earnings. So you were just a little bit over 75% of the cost of the pension being paid for by employees and investment earnings. When you transition into a different type of plan, like a 401k, you lose out on those investment earnings that are helping you pay for the system, and that's part of the reason that it costs more to administer retirement benefits under a system like a 401k. And then, as I mentioned, you've got to think about pensions as a tool for workforce management, particularly as it comes to recruitment and retention. The city of Palm Beach, Florida, learned this the hard way. They moved their public safety officers, I believe it was to a hybrid plan a few years ago. And what they found was, they were getting public safety officers like police and firefighters. They trained them. Those costs are very expensive to a locality. And after the folks went through training, they were like, well, I'm out. I'm going to go to this city over here that's giving me a pension because that's a better retirement benefit for me. And particularly in public safety, some of the death and disability benefits that come through the pension are extremely important for the type of work that they do. So the city of Palm Beach, Florida, this past year decided to reopen their pension for their public safety officers because the recruitment and retention costs were so high to the city, it wasn't worth it for them to stick in that alternative plan. And then the last thing I'll say is that pensions pay for themselves. And I'll encourage you to look at the National Institute for Retirement Security, I think is their acronym, NERS. There are too many acronyms in pension world. That's the other thing I'll say about all of us. But anyway, so NERS estimates that for every $1 that's paid out in state and local pension benefits here in Vermont, that supports $1.29 in economic output in the state. And that's, the direct and indirect and impacts of retiree spending with those dollars. Now, they also estimate that for every dollar the taxpayer spends to pay for a state and local pension plan in Vermont, that multiplier is actually supporting $5.84 in total economic output in the state. And that's, again, because of what I talked about. So much of the value of the cost of the pension is paid for by the employee and the investment earnings. Your money as a taxpayer is multiplied by basically 5.84, and what you're getting out of the amount that you're paying for a pension in the jobs that retiree spending is supporting, the businesses retirees are supporting when they're going out and spending those pension checks. And I know the average pension here in Vermont is actually fairly small. I think it's $18,000 annually or something like that. So if that's what you're living off of in retirement, you're not saving that money anymore, right? You're going out and spending that in your community. So I think that's an important thing to keep in mind, is that pensions really are a good value in a lot of ways for the state and are paying for themselves in the revenue and economic activity that they generate in local communities across the state. And so with that, what I want to leave you with, and then turn it over to the treasurer to talk about some more specifics on Vermont, is really the human impact that we've always got to keep in mind when we're having these discussions. And so hopefully I will be able to do this. So this is from a retired member that we met in Michigan a couple weeks ago, and I wanted to share her story with you and let her tell you. But this to me is, why I get up every day and work to promote pensions and retirement security for people in this country.
Hi, I am Marcia Lever, and I am a retiree from the state of Michigan. I've worked in children's services for approximately 25 years. The pension itself has been really helpful to me. At the time I did retire, I actually took an early retirement because I was dealing with breast cancer, and it was time to do radiation, and I had run out of sick time. And so anyhow, I figured out what my pension would be. And between my pension and I also did have money invested, I figured I could manage to live and be comfortable and be able to pay my bills, which of course would have been impossible if I didn't have a pension. So then I would have had to go on long-term disability until I was able to be back at work, if I was ever going to be able to be back at work. So the pension was just a lifesaver at that point for me. I volunteer for the St. Vincent de Paul Society, and I work with people that have problems paying their utilities and their rent, and we try to help them financially And many of the people that we deal with are seniors who are on a fixed income, and basically all they do have is their Social Security. And without anything in addition to their Social Security, they especially in the wintertime, have difficulty paying for their rent and their utilities or the medication that they need. So they just kind of juggle things around until they're at a point if things are being shut off for them. So I just thank God every day that I have a pension that I can rely on and know that I don't have to deal with these things.
Thank you.
So while we're waiting for that, I do want to tell a story. This doesn't count toward my presentation time, so hey. So I do want to tell a quick story, which is, thank you very much, David, for the kind words. I wanted to point out when David and I first met, which was back when I was a deputy treasurer for then Treasurer Jeb Spalding. And Jeb, frankly, was the reason I came to Vermont with the work that he did and the vision that he had in the treasurer's office. And I've never looked back. It's just a great place. But he introduced us and he said, "You two will like each other. You're both geeks." And that turned out to be correct. And while we do not agree on all of these issues, I will point out that we served together on VSAC, we served together in the bond bank, we served together in the capital debt affordability, and David is a man of integrity, and it's been a pleasure to work with you. I look forward to working with you, Mark. We don't know each other as well, but I look forward to working with you as we have these conversations as well. So just call us both geeks. So with that, and Tim has the clicker. Okay, so we're going to let that happen because if you had me doing both, not all that coordinated, so hey. So thank you very much, and I am a bit of an in-the-weeds kind of person, so my presentation has a lot of information, more than we could possibly cover today, and for that reason, we've provided a copy at your table, and would welcome you to take a look at it, take it with you, ask questions, and we'll go over a few sections today, but if you have questions, call Tim, 828-1452. So, okay, and he will get those questions to me. I think we should start with a couple of basic concepts. Number one, you get what you pay for and need to pay for what you get. Two, we are now bearing the consequences of past failures to properly fund the retirement systems. And three, there are no quick fixes. Discipline is needed and prudent planning is required. Moreover, getting to some points that Bailey mentioned, we want adequate and reliable retirement income for retirees at an affordable cost to the taxpayer that does so in a way that promotes a productive workforce and supports a growing economy. On page 3 and 4 of the presentation, very good, Tim, okay, I've listed some quotes from historical records, and I don't do this to embarrass anybody, but let's be frank, budgetary constraints, prioritizing the funding of operating programs over already earned benefits, and the misplaced belief that somehow investment return would solve the whole problem is just at the heart of our current pressures. We are paying for the sins of the past. This was not malicious, but it was short-sighted. It was also a bipartisan effort, or in this case, mess-up. On page 4, I would reference a quote from Treasurer Douglas that stuck with me, and it said, and I underline that section, "A failure by the state to address fundamental weaknesses in our revenue structure and spending patterns." Now, while former Governor Douglas and I may differ on some points on this and how to get there, we share the same sentiment, and I believe that that is the heart of our efforts to address these liabilities. Let's move to page 7. See if it gets there, okay. Underfunding of our actually recommended contributions, or the ARC, as we've talked about today, especially in the case of the teachers system, has contributed to the increase in liabilities. Looking at page 8, let's go to the 8 for a minute, okay? This combined with the failure to fund teacher health care, which was paid through the pensions. Not only do we underfund the ARC, we also paid health care out of there without budgeting for it, contributed to our current situation. How bad is it? Let's go to page 9. And you see that $25 million of today's ARC is the result of those shortfalls. We are paying $25 million more today in that annual ARC payment than we needed to if we had funded this correctly. That's about 1/3 of the ARC payment. Page 10 is a graphic illustration of how our liabilities have grown, and I would agree with David that they've grown. Clearly, the Great Recession was a major driver of these liabilities, as seen on the next 2 pages. Let's stick with this one, though. Go back. What can I say? In both cases, workforce decisions also had a big part of it, healthcare for the teachers. The workforce issues are extremely important as you're looking at this. In the past, we did 2 state retirement incentive programs. The idea is we'd incent people to retire, and then we would not fill those positions. We filled the positions, so we upped pension costs and didn't save any money at that end. I'm aware that at the local level, many contracted payments are made to incentivize retirements. While that may reduce the cost for the teacher system, for local school systems, you'll see that it has an upward pressure, if you go to page 14, an upward pressure on the pension contributions. Think about it like squeezing a balloon. If you squeeze it at this end, it pops out at the other end. And the reality is that when we make these decisions about workforce and what our education system looks like, we need to do that with a full understanding of the cost implications from start to finish, being retirement. Keep in mind that we are updating our current assumptions, particularly we've talked a lot about interest rates and return assumptions and mortality. And I'm not going to kid you, this is not going to get better, it's going to get worse. Go on to page 15. Okay, we're there. Okay, healthcare. I actually put this in for a little bit of humor. That's the bill that my mother had, parents had in their records for my birth and my twin sister's birth, okay? That was 1953, so now you know how old I am, okay? The cost, $104.05. My mother used to say that we were worth $52 each. We'll leave that alone, okay? Applying CPI to that, just plain CPI, we would project a cost of just under $1,000 in today's dollars. However, the average cost, as you see there, is about $17,000. Bottom line, healthcare costs are rising faster than inflation. We need to address a comprehensive solution for all healthcare costs. Look at the Medicaid budget at the bottom. $1.7 billion, 46% paid by state. I did get that from JFO. This is a big issue. The cost of healthcare is outpacing all state costs in our federal and state governments. We need to address this issue, and we need to address it across the board, not just in retirements. That doesn't eliminate the need to address retiree healthcare costs, and the next few pages provide some insight as you look through this package on the changes that we've already made, including benefit changes to state employees and teachers around healthcare. And there's a slide that will show you where that we've made those changes, so you've got to work longer to get a health care benefit. That said, pre-funding of these is critical. I agree wholeheartedly with David on that issue. We have created some opportunity for pre-funding with some changes we've made post-2014, what we call the Retiree Teachers Health Medical Benefits Fund. If we keep to the discipline and don't pull the money out of the fund, we will generate surpluses that can be used to develop pre-funding, but we need to keep that discipline. Let's move on to page 20. Let's talk about our bond rating. Pension liabilities clearly are a need that's been addressed with the rating agencies, but they also mention other concerns that have been brought up before, an aging population and workforce, and slow economic and revenue growth. I would suggest these are all interrelated. Retirees with adequate and reliable income buy goods and services. That creates jobs, and that stimulates the economy. We have to have a holistic approach to what we're doing. Let's turn to page 21. One of the rating agencies, Moody's, who has assigned us a AAA, which is the highest rating, has affirmed that there is a pension, our levels are higher, but they've also identified our aggressive efforts to address those in our current policies, as noted on page 21, that puts us, as you see in the underlining, in a better path than some states in terms of these issues. Going back to Greg's presentation earlier, what we are doing are some of the right things in trying to solve this problem. Moving on to page 22, Fitch cited our track record of funding more than the actuarially required contribution. We're not making the minimum contributions, we're actually paying a little bit more than that, and that's helping along the way here. The next chart actually came from our friends over at Pew, And it might be a little dated, I apologize, but in that it said that 15 states have achieved positive amortization, Vermont being one of them. Now, I will grant you, we're one of those little blue markers, not the big ones, but in 2016, we made a change to our amortization policy to flatten it out, so it isn't 5% increasing increments anymore, flatten it out a little bit. That's going to save the taxpayers $165 million in interest costs. Let's move on to page 25. I won't kid you, we've got some big issues here, but let's take a look at that $313 million that we were talking about a little earlier. As you can see, those are nominal dollars. If you adjust for inflation, just as we looked at the opposite of the bill for my birth, that you see the differing inflations will result in differing dollars in terms of $217. I think that's important to recognize. I won't kid you, it's still high. But look at 2038. We will have paid off the mortgage. And when we pay off that mortgage, we will be able to use those dollars for other operating expenses or be able to use that to lower our expenses. I think that that's an extraordinarily big opportunity if we stick to the funding plan. Moving on to page 29, you see some examples how we've engaged state employees. We talked a little bit, how do we do this? I know, John, you asked a lot of questions about how do you start this? You start it by engaging employees and having a conversation with the stakeholders. And those have been very, very successful. And they've contributed meaningful contributions to addressing our liabilities. The changes that we've made in the teachers system, for instance, pushing out the age of retirement, increasing contributions, going to save $16 million per year, the 15 plus the $1 million there. That's a very important piece. State employees, they could have actually seen their contributions go down by statute this year. We went to them and said, can you not go down and can you put a little bit more in? They said yes, and that was $8.4 million in 2016, over and above what they were required to do that employees put into the system to address the issue. They are engaged. They see this as a partnership. We need to continue that promise. Let's look at pages 30 and 31. This is, and obviously you're not going to be able to read all this, it's in your package. These are the various initiatives that we have taken since 2005, and I've categorized them and quantified them starting in 2010, where I had a little bit better actuarial data. And bottom line, some of these are annual. These are conservative estimates, the beginning annualized cost. Some of those will increase over time. We have generated savings to the taxpayers of $1.3 billion. Let me repeat that, $1.3 billion by the changes and the incremental changes that we've made in partnership with the governor, in partnership with the General Assembly, and in partnership with our employees. Let's move to page 33. There are no quick fixes, and the bottom line is that we should remember that that in assessing our options, we should get best value for both employees and other taxpayers. I provided some cost-benefit analysis of defined benefit and defined contribution plans on page 33, and the bottom line is that a well-run defined benefit plan provides best value to the employees and future retirees at a lower cost for the taxpayer. It's a win-win situation. Better, bottom line, better benefits for the cost, less cost, and better for the economy. Changing the system away from a defined benefit plan will add more dollars to the normal cost, and that's that calculation that you're going to have to kind of dig a little bit as you're looking at it, and will not reduce the unfunded liability. That means that more dollars will have to be appropriated each year if you move to a different system. As noted on page 34, studies have consistently stated you get more investment return from defined benefit plans. That's a bottom line. Towers Watson's been studying this since 1995 and reported, on average, defined benefit plans outperform defined contribution plans in terms of the amount of money that's generated. So, bottom line for me, better benefit at a lower cost while protecting retirement security and creating economic benefits should be our goal. No quick fixes. I think you've heard me say that a few times, but fiscal discipline can help us achieve this. This past year, we did something very novel. We passed a bill permitting the implementation of a voluntary, and I do mean voluntary, retirement plan for private sector employers who do not currently have a plan. I'd be pleased to talk to any employer that wants to ask questions about that as we move forward. But right now, 104,000 Vermonters do not have access to employer-sponsored retirement plans. This provision was included in the Economic Development Bill passed by the legislature with the recognition that increased retirement benefits results in increased economic activity. This is even more the case with defined benefit plans. Turning to page 36, the use of a defined contribution plan or a hybrid plan will not eliminate the unfunded liability for reasons that are highlighted on the next page. I'll let you take a look at those in detail. And in fact, those unfunded liabilities will increase. We've seen that with West Virginia, Alaska, other states, and I've taken a look at some closed systems in Vermont, and that is absolutely the case. Finally, as noted on page 39, DC transfers additional costs to the public sector. I fully disagree with Mr. Mennis's proposition that this isn't a serious issue, unless you're in one of those 7 Social Security states. Moving to a DC or hybrid plan will create inadequate retirement income and require individuals to seek additional supports in the form of assistance payments. These do not have the advantage of being benefited from investment income. Every dollar we pay to a retiree right now in a defined benefit plan includes gains from investments. Roughly 70 cents out of every dollar paid to a retiree in a defined benefit plan comes from investment income. When folks do not have adequate or reliable income, they rely on public assistance, which is paid dollar for dollar. No investment return is part of that mix. This results in more pressure for the states and federal government in terms of their budgets. Let's turn to page 40. Going back to the comments that we made at the beginning, and I again underlined Governor Douglas's statement that he made back in the 90s when he was a treasurer. We need to avoid quick fixes and address the fundamental weaknesses in our revenue structure and spending patterns. To do this is a long haul. We need to be disciplined in our funding, update our valuations regularly, and continue to make decisions to responsibly meet the obligations of our taxpayers and our plan beneficiaries. We can do this in Vermont. We can work together to continue the discipline to provide retirement security at the lowest possible cost to the taxpayer, and I believe that is through defined benefit plans. Thank you very much. Oh, we have named things. I should probably sit at the right one.
Okay, we're gonna be taking some questions. Did anybody have cards that they want, or do we just want to do microphones? So if we can have, raise your hand if you have a question. We have somebody up front, or over there. Okay. And while we're waiting for that, I just want to say, Beth, thank you for 2 things. That I knew you've saved us a lot of money. I didn't realize it's $1.6 billion, so I want to applaud you. 1.3. I want to applaud that. That's amazing work for all the taxpayers, me included. And the other is, I think the work on the public retirement system, for so many people don't have access. And as a concern as somebody involved in financial literacy, I think what you're doing to make sure people have payroll-deducted pensions
If I could just, thank you first,
Yeah.
thank you. I think that both of them are a team effort. The $1.3 billion wouldn't have happened without the members of the General Assembly that are sitting in our audience today, the people that worked in GovOps, approps across the board, and each of the governors that I've had the pleasure to work with. All 3 governors have been wonderful working with us to try to address this problem. It's a team effort, and again, the employees have stepped up to the plate as well. That's how we get things done. Washington should try some type of model like that and see if it works. So.
Okay, go ahead.
David and Mark, I understand that you didn't give us a prescription for the future, but it seemed that you are asking for something other than what we have now in the hope that whatever it becomes is going to be less expensive than what we have now, and you're going to use the difference to pay down the debt that we have now. Is that correct?
Let me take that, Mark. I don't think we're going to see a reduction, using the ARC as the example for the pensions. I don't think you're going to see a reduction in the short run, but you will see a reduction in about a 5-year period based on the studies that I've seen. So we wouldn't walk into this thing thinking we're going to save money initially, but we would obviously be limiting our risk going forward, and we would put a kind of a fence around it so we could start dealing with the unfunded liability piece of it. Right now, if we don't do something, then that's going to continue to expand, that I think will certainly more than eat up the additional cost.
But it is your assumption that at some point, whether it's now, 5 years from now, 10 years from now, that whatever we do, whatever change we make, is going to cost less than funding the pension plan as it is now. Forget what we owe.
Right.
The annual cost of a defined benefit plan you see as higher than the annual cost of some kind of either defined contribution plan or combination, hybrid, as they said.
No. No.
Then what do you see
as
gaining?
I think you heard Beth talk a little bit about it, but a 401k plan is a percentage. The employee puts a percentage in, and the employer does. I think Vermont is paying about 7%. Right now, we're paying a very small percentage of the payroll for the normal cost, but you can't forget the unfunded liability because that's 4 or 5 times more than what the normal cost is. So at the end of the day, what we would do would be able to put, I think, a handle on terms of what our exposure is and our overall cost. But you have to put the overall cost in there because that's built into it.
But it's there anyway. Irrespective of what plan we do, that unfunded liability is still there and has to be dealt with. So my question to you is, do you think that some kind of combination plan, a hybrid plan, is going to be cheaper annually, and therefore we would save money, than a defined benefit plan?
Yes, I do.
Annually.
Yes, I do.
If I could respond to that.
Sure, absolutely.
I think that if you go to page 33 in our presentation, you see that especially on an annual basis, in the first years, the normal cost would be replaced with a much higher employer cost. So if you have a 7% defined contribution plan, and we're currently, I got to put my glasses on to see this, that used to not have to happen, 2.88% of payroll. So instead of paying 7%, you're going to pay 2.88% of payroll, which is a 4.12% payroll increase. If you were to do that for the whole population of the state, just the people that are in the pension plans, the defined benefit, that would be $19.4 million increase in 2017. Obviously, if you used, phased it in, you'd have less, but it would still be a substantial amount. For the teacher system, that's even higher, because the teacher system, the normal cost is 1.33% of payroll. It used to be twice that, by the way. Back in 2010, the changes that we made, the benefit changes that we put in place, actually cut the normal cost for the teacher system in half. That would be a $33 million increase. So the normal cost would be a problem. Now, those will fluctuate over time as you have new entrants and so on, but there's a bottom line that what you would have to pay in a defined contribution plan versus a DB plan would be higher. The thesis is that you're going to reduce your unfunded liabilities. The experiences in Alaska, the experiences in West Virginia, the experiences in I'm thinking of one other state, Michigan, thank you, don't support that. That in fact the unfunded liability continues to grow, and there's a couple of pages in our presentation that go over why. I'm looking at that in some closed systems that I've seen locally in New England and Vermont, and what I've seen is the same pattern, an increase in unfunded liability and an increase in the ARC, while you still have that closed plan and those closed plans. So I do not believe that that is a cost-effective method of delivering pension services.
Well, I disagree.
Yep.
On the basis that if we continue the way we are, the new people coming in, and keep in mind, I think since 2010 we've added about at least 7% more to the state workers, and maybe even 10% now. It was 7% a couple of years ago. So we continue that same risk going forward. So what is there to say that all of a sudden a defined benefit plan is going to be cheaper when in fact we are assuming more risk because all of the risk is with us? So I think that when you analyze it all, it would be much cheaper to have something like whether it's a hybrid or defined benefit, a defined contribution plan today, because we de-risk the state immediately.
I would say that your funding policy is key. It's not going to be the design, the plan design. It's whether or not you're paying your normal costs every year like you're supposed to. And the chart that was in the treasurer's presentation that showed all of the years that Vermont did not make its full payment is a big driver of why you are where you are now, because there shouldn't necessarily be an unfunded liability if you're making your normal costs every year. Yes, there are going to be market fluctuations, but over time, those should even out at full funding as long as you've been making your payment. So I would say, like, looking at your funding policy is something important that you all could discuss.
Okay, let's move on to another question.
I want to pick up on something that Bailey said, that the treasurer said, that David said, and I would suggest that technical solutions to this problem are a waste of time and will be unproductive. Tinkering at the margins, working with Excel will not solve the problem, so I would like to raise the 800-pound gorilla here. And let's talk about, first of all, for the benefit of Bailey, who's from out of state, we face a range of issues here in Vermont. As David has said, we're the oldest state in the country. We're on a glide path to becoming a giant forested nursing home. We have an affordability crisis for our young people. We have seniors who cannot afford to stay here. As my colleague Art Wolf has pointed out, we're losing pensioners and retirees earning over $75,000 a year. We have an opioid crisis with severe underfunding for DCF with literally life or death consequences for some children. Those of us who live in Chittenden County probably know we have no state troopers on duty between 11 at night and 6 in the morning. The Attorney General's here. I hear a rumor we're going to require criminals to sign a waiver when they move to Vermont that they must go to bed after Jimmy Kimmel. We have the mandated Lake Champlain cleanup, which is $50 to $100 million a year. Where will all this money come from? We will not address this problem until someone has the vision and cojones to talk about the $1.6 billion spent year in, year out on the K-12 education system in the face of declining enrollment and, I respectfully suggest, mediocre results. And that has to be addressed, and technical solutions will not get us out of paying for the bill. And you see this ongoing disagreement here. It's not even clear that we can, just tinkering with it. That's my comment. I apologize. I have to leave shortly to go to work to pay my property taxes.
Okay. Could I just a quick response to that? I'm not going to get in. I'm not an education funding workforce person. I'm a pensions financial. I was going to say geek, but I was trying to stay away from that word. That said, they are linked. The changes you make in the workforce have an impact on the pensions and the decisions that you make. And what I would heartily suggest is, and something I said in testimony in Senate Finance a few years ago, they are linked. And as you're working through these solutions, we would be happy to work with you to determine what the impacts are in terms of the pension systems. So I don't have the answers on education funding, but I do know that we can work with people to try to identify those impacts as they relate to the other side of the balloon, the pension side. But they are linked. When we make choices at the local level, we have impacts at the other side.
Okay. Who's got the mic? Next mic is where? Right there, sorry.
Mic in hand. So 2 questions, one for Mr. Coates, one for the treasurer. Mr. Coates, at the end of your presentation, you started to get into a lot of other stuff that are priorities in the budgetary world. In most of the discussions we've had so far, that has sort of been brushed aside. Lake cleanup, agricultural, redoing Interstate 89 are all budget pressures, and I wonder why you've skipped over those to some degree. And Madam Treasurer, the representation sort of when somebody says that this is impacting our financial statement, where is the money actually coming from? Is this general fund money? Does it come from other places? There's a different level of impact depending upon where it comes. And I'm not going to do my property taxes, but my dog has its legs crossed.
Part 1 and Part 2 we can start with.
Let me, it's a question of affordability. We only have so much in the general fund revenue side of this thing, so how much should be allocated to the various components? And to the extent we're increasing the pension piece of this, that means the pie, if it's the same size pie or growing in the same proportion, then the piece of that pie is much bigger going to the pension side, and that means other programs aren't going to receive the benefits or the funding that they would need. And that's the reason why I bring up the other pieces, because it's a matter of establishing priorities, Bob.
So I guess I'm going to start with the impact on the financial statements. Yes, GASB 67 and 68. 68 actually was the piece that put it on the financial statements, and that did happen last year. That's in the entity-wide financial statements. It does not hit the general fund. That was one of the myths that was out there, that this is going to blow out my general fund budget. It's part of the entity-wide, government-wide financial statements. And for those towns that don't do GAAP accounting, you don't have to worry about it, but you got other worries, because you should do GAAP accounting, right, sir? Absolutely. GASB 74 and 75. So 74 comes in this year, and we will have it in our financial statements. And it's going to be a bigger number because of the method that we use for funding is going to be different than the method that they're using to make apples to apples in the GASB mix. And even with apples to apples, you're still going to have grannies and Macs and different apples, but we'll get past that. But again, it will be on the entity-wide financial statements. It does not hit the general fund. So that's part one of it. Part two of, I think, what you were asking is where the source of the money comes from. Not all of it is general fund. The money that's paid for the ARC for the state system, the state employee system, VSERS, that is distributed across every cost center in government. And in the past years, I've seen someplace in joint fiscals here between 35 and 40%. When I did the retirement incentive a few years ago, joint fiscal and the administration asked me to use 35%, calculated the retirement system, didn't propose it, calculated it. It was 35%. So roughly 35% of that state employee system presumably is coming from the ARC is coming from the general fund. For the teachers system, as you know, the governor proposed and the legislature did put just under $8 million of normal costs into the education fund. The treasurer is not taking a position on that, just for the record, okay? We are glad that it's funded. Where you fund it is a position for the legislature and the administration. So $8 million is not general fund, $8 million is education fund, and an additional $4 that's growing to 4.68, and I think possibly up to 4.8 million is going to be paid by local schools, because we've said if you have a federal grant, you must put the pension costs into that federal grant and then bill back those federal grants. So we are collecting last year about 4.2 million. Our budget's built on 4.6 million. I think we're going to get up to 4.8 million. So not all of those monies are coming from the general fund. There's a variety of sources. Mike, again, I don't take a policy decision on the education fund piece. My bottom line is pay the ARC, which I've been saying since I was a deputy in 2003. So. Okay,
but the bottom line, excuse me, that when you take a look at the CAFRA, which is the government-wide financial statements, we will have, right now we have a $1.2 billion net worth. At the end of the day, when we put all of these obligations on, we're more likely than not going to have a negative net worth. General fund not excluded from that, but it's part of the statewide financials. So we would have a negative net worth.
Art?
Yeah, I wasn't paying attention to this issue 30 years ago, but presumably at the federal level, the federal employees had something like what Vermont has now, and then they transitioned to the thrift savings plan, it's called, which is essentially like a 401k type program, a defined contribution plan. And I assume that's what David would like us to move toward, something like that. It seems to work at the federal level. The treasurer suggests that moving that way is going to cost more and be worse for the employees. So I find it hard to believe that the federal government moved to a program that was going to cost the federal government more for its retirement system. And I don't see I don't see the federal government having a hard time attracting employees, or I don't see federal employees complaining about their retirement system. So I'd like to look at the parallels there, and you can comment about that.
So if you go to, I'm struggling to get to the right page here. If you go to presentation, on page 34, Towers Watson, I think the Willis Towers Watson now, has been comparing annual returns on DB plans and DC plans since 1995. And what they've said is that DB plans consistently outperform DC plans. Now, I believe it was 75 bips, 75 basis points on average the last time I looked at the study. Don't quote me on that. I'd have to, I'm doing that one from memory. And memory is what it is. But if you do that annually every single year, that's a significant amount of money. That's supported by other studies by the National Institute of Retirement Security. You did get that acronym right, NERS. We do have too many acronyms. There's another study that's been done by the National Institute of Retirement Security too, called Still a Better Bang for Your Buck. And it says that DB plans deliver a given level of retirement income at a cost that is 48% lower than 401k type DC plans. It's written by a bunch of actuaries. Go to it. After you've taken a look at it, it talks about longevity risk, something that John brought up earlier, and frankly, DB plans do a better job than DC plans in dealing with that. It talks about the diversification of the portfolio, the investment fees, and again, I would encourage you to take a look at that report and be happy to have a discussion with you about it. But the data that I've seen says to me that DC plans are a better bang for your dollar. DB plans. Let me rephrase that. I liked your first analogy. You liked that first time. You liked that first time. DB plans are better bang for your buck, and they provide more retirement security. Your question about assistance payments, I'm just going to do a little anecdotal piece here. We do something called EGWIP, which is the Employer Group Waiver Plan, which is a way of getting, what we did is we changed the way we dealt with the federal government about health care, and we ended up getting about $4 million more a year for the same benefits, and we just changed our relationship with it. But that also provided for low-income retirees some discounts on prescription drugs. And we saw a large number of our retirees, okay, particularly older retirees, that qualified for that. In addition to that, Linda, I was at something when you were doing a presentation to the Retired Teachers Association, and she was a presenter in front of me, and she did a presentation on how to apply for food stamps. Okay, so there is a need out there. Paying a little bit more for your retirement program and getting less retirement security and less benefit from it doesn't seem to be something that I would want to take a risk on, given that that has a detrimental impact on everyone, including that, was a teacher from Michigan? Okay. So that would be, again, my perspective on it. I've seen anecdotal data that tells me that. There's a study out in Utah that does an analysis of how much when you lower income people and how much you increase retirement and the reductions in state expenditures on public assistance. I don't have the report that's referenced in here someplace, but I'd encourage you to take a look at that as well.
Okay. Let me, go ahead.
Oh, I was just going to add that I know we want to talk about solutions. It's very human nature, but we're not going to decide today, obviously, whether it's a defined contribution or defined benefit route or some hybrid thereof that matters. What I do know is that we're not meeting our liabilities, and I would suggest that we get better informed by doing something that Greg mentioned, and that is undergoing a stress test so that we get some real answers and are be able to make some informed decisions here.
One final note, the DC plan, the money belongs to the participant. So at the end of the day, they walk away with that as a minimum. Now, they have to determine how they're going to spend it in retirement, but when you compare a DB plan, if something happens prior, they lose any benefits going forward, where the DC plan, they continue to receive those benefits because they own the money, unlike the DB plan.
I would just throw out that the median average defined contribution account in this country is $18,000 total. So I think you should ask yourselves if that's an amount of money that you would like to retire on.
Averages always aren't correct, as we well know.
That's true.
Yep. Okay, let's go with another question. We have time for a few more.
Yeah, this is on the longevity as one of the big risks, and I think Mr. Coach just alluded to it. The risk of longevity is just what you said. It's not just taken by the state, it's shared by the employees. One person dies the day after they retire, another person lives for 30 years. The employees share the risk of longevity, not necessarily the state. So I just said that major risk is, I'm afraid to say it's mine.
I guess you could say that, sure.
Yeah, it was just, you just agreed with me earlier. Thank you.
Fine.
Okay, was it, did Mike, you're next, and then somebody else.
So as I've listened to the two sides, I think everyone has agreed that we have two costs. We have a the cost on a go-forward basis, and then we have the cost of taking care of the unfunded liability. And no matter how we move forward, that unfunded liability is there for us to deal with. And much of what I think I'm hearing from some folks anyway is the concern that as we move forward and we are faced with different economic realities, we may not have the discipline, the financial discipline, to make certain that we are paying as we need to. And if we were to put into statute a requirement that we do that, that may alleviate some individuals' concern about this, because we are where we are because we took the easy way, and we, instead of paying our monthly bills, we put it on a credit card, right? And then we allowed that credit card to continue to grow. So if we were to put some legislation in place to deal with this, that would alleviate some of the risk, albeit it may not be, if you're in a contract with employees and having to pay as you go a defined contribution, you're not going, that can't be kicked down the road, right? You're going to be paying that every year. You don't have the flexibility of not paying that in a given year, whereas we have the defined contribution plan has given the legislature the flexibility to not pay in certain years. And we are now burdened by that flexibility. Yes?
Well, I agree. We have no flexibility once we have a defined contribution plan. And the only way I can see this happening is that if there's a structural change, say there is a defined contribution plan or a hybrid, that may qualify as a structural change. Then I think we have an opportunity to amortize the amount over the 30 years, although Greg was talking about the fact that they're going down to 20 years, but I think we're on a 30-year pattern right now, and to the extent there was a structural change, that would give us a basis, I believe, to go back and start amortizing again over 30 years. It may cost us more interest, but it's got to be affordable based on the fact that we only have an X number of dollars in our revenue pool. And to the extent it starts taking more of the revenue pool, it drives out the other programs, and that's my concern. So how do we get around it? Well, I think we get around it if we start the amortization all over again, but we just can't start that willy-nilly. We have to have a basis for doing it.
So if I could on that, a couple of things. Number one, I wouldn't trade off less benefits to put it into a DC plan because that we don't have the ability to exercise discipline. I think that we have to learn to exercise discipline, number one. That's hard to do. Let's take a look at our federal institutions. That's really hard to do. And I'm proud to be a Vermonter and to be here with a group that does address these issues. In the dialogue that we've had, the dialogue that David and I have had over the years on this, on debt and everything, has contributed, as is the dialogue in the legislature and with the administration. You know, talked about the lake earlier. $25 million is what we targeted that the state share should be. We'd be able to fund the lake and still have a funded pension if we had done the right things. Let's not step backwards. It was those budget constraints that got us in there in the first place. Oh, we can't afford this. We got to figure out a way to do this, and let's do that. We'll pay it down the road. There are no quick fixes, and we have to have the discipline to do the right thing. It's hard to do.
Okay, this is going to be our last question, and then we'll go to lunch, and hopefully if you have other questions, you can talk to panelists or others directly after or during lunch. Thank you.
I have one question for Treasurer Pierce and one for Mr. Coates. Treasurer Pierce, a lot of people have just talked as though people work 30 years and get compensated at today's rate of salary. I just thought it would be useful if you could tell us the average pension for a state retiree and for an educator in Vermont.
Averages do have issues, we'll go with that, but, and I will concede that, but we do have an average of just over $18,000 for state employees and just over $19,000 for teachers. Now, the average Social Security in this state, I think, is someplace around $12,000. That number might be a tad old. So we're not talking big benefits. When Greg did his chart showing the benefit structures, the multiplier, once in a while we got above average. Most of the time we were average. Back in 2005, we characterized the benefits as modest at best, and I would say that that's pretty much where we still are.
Well, can I just add to that, Greg? But when you look at basically what the plan is, somebody that stays to retirement is going to get either 50 or 60% of the average of the last 3 years, I believe it is, of their annual compensation. So when you look at it on that basis, that's what people should be planning. The average is misleading. Well, you have people that only are in the plan for a certain period of time or leave the state. I mean, that's why you can't go on the average. You got to go on basically what did they get if they stayed at full retirement.
So that's never cost to the system. But I'm puzzled because we have a perfect experiment in terms of what you'd like to do, using the Pension Benefit Guarantee Trust sort of as a hammer. Defined benefit plans have been largely reduced in the private sector, and it's very hard to open a magazine on the subject without talking about how poorly prepared these people are for retirement. Amazingly enough, if they're able to get it money and the children have problems, they tend to use it. You have the problem that they tend to get less money, that you need to assume the longest you might live, whereas a DB plan gets to assume an average. By everything I read, the magnitude of the liability that the private sector moving to DC plans is leaving for federal and state governments makes these kinds of issues look trivial. And I don't know why you're not more worried about that.
Well, I guess we're worried about everything, but at the same time, there's a limit in terms of exposure, whether it's a company or whether it's the state of Vermont. And I think you have to look at that aspect of it in everything that we do. We just can't be pouring money into something, expecting the best results in that. Instead, we have to look at essentially how much can we afford. And I think that's the point that I've been trying to make today, is that we have limitations in the state of Vermont, so we've got to kind of tailor these things to a point where we can afford them.
Last word, Beth, or?
Again, I would just say that this is a state where people work together to find solutions. We've done some work. We've made some progress. Let's continue to make the progress. Let's continue to involve the stakeholders, the employees, in the decision-making process and work with them. The fact that employees stepped up to the plate. We came and said, you can't go down to 4.85, you got to stay at 6.4, and please could you go up another 25 basis points in your contribution? And they said yes. They stepped up, and there was $8.4 million that helped the 16 budget. That's important to me. I'm grateful for a state where people work together. And I'm grateful for a state that also has people like Mark and people like David that are concerned, that care, and are working with us to try to find solutions.
I agree. If we had gone back to the 2009 retirement committee that met, we had a lot of suggestions on the table. Some of those were bought, some of those weren't bought. And to the extent all of those would have been implemented, we'd be in a different position today. I think we can do the same thing going forward.
Great. Well, thank you for 4 hours of your time. We do have lunch in the back. I want to thank our panelists. And thank you for coming.